colleagues De La Cruz of Texas and Sherman of California. Both seek to address the same issue, helping our nation's wounded warriors access critical housing assistance. Representative De La Cruz's bill, H.R. 7480, would fix a long-standing problem regarding how its CDBG program treats service-connected disability compensation for disabled veterans. I have called on the Housing and Urban Development Department to fix this problem on their own for years to no avail. So today we'll pass her bill and stop needlessly excluding disabled veterans from the help that they need. Similarly, Representative Sherman's bill would instruct the HUD to stop including disability benefits received by low-income veterans in determining eligibility for its HUD-VASH homelessness program. HUD-VASH has long been a successful program to help end veteran homelessness. We want to help more at-risk veterans, not exclude them. We'll also consider the Yes in My Backyard Act. This bill has passed this committee in previous Congresses, and I look forward to advancing it again today. It's a critical first step to ensure we build more housing to address the affordability crisis that we all agree is a massive issue and one that we should address in a bipartisan way. Last but not least, we have Subcommittee Chairman Davidson's HUD Evaluation and Optimization Act. This bill is a common sense approach to require HUD to work smarter, not harder, to solve today's challenges. His bill establishes an independent bipartisan commission to review the structure and effectiveness of HUD and its programs. The commission would then issue recommendations to Congress. Look forward to the debate on this, and I said that I wanted to be brief, but unfortunately I was not. With that, I'll now recognize the ranking member for an opening statement.
Thank you, Chairman McHenry. Good morning. Today, most of the bills we're marking up, unfortunately, are not only partisan, but also massively deregulatory, harmful to our nation's consumers and investors, and do nothing to address one of the worst affordable housing and homelessness crises our nation has ever seen. The American people have said that they want Congress to do more to strengthen the economy and lower costs for families. In response, extreme Marjorie Taylor Greene and MAGA Republicans are wasting our time with failed resolutions to kick out their own speaker and bring in silly pieces of legislation to the floor with names I wish I was making up, like Liberty for Laundry Act, Refrigerator Freedom Act, and Hands Off Our House Appliances Act, proving yet again that they're not serious about legislating. Simultaneously, committee Republicans are proposing legislation that would put our economy on a collision course with financial instability. For instance, today, committee Republicans are proposing a package that would weaken requirements established by the Consumer Financial Protection Bureau to increase lending opportunities for small businesses, particularly those that are owned by women and people of color who face persistent barriers to accessing the capital they need to start or grow their business. Given that small businesses are responsible for creating 2/3 of new jobs, this bill will stifle their growth and harm our economy. I am so pleased to learn that just today, the Supreme Court supported the Consumer Financial Protection Bureau and the source of their appropriation, which is the feds, which keeps them from being a political tool by the opposite side of the aisle and Republicans attempting to defund them. They won't have that opportunity, thanks to the Supreme Court. I want you to know that we're so proud of the Consumer Financial Protection Bureau. They handle 3,000 complaints per day. They have returned $17.5 billion back to our consumers. And I want you to know that they have contacted and worked with 4 million companies and sent the complaints over to the companies to help our consumers. So I say this because I want the opposite side of the aisle to understand how important the Consumer Financial Protection Bureau is to all of our consumers. However, Republicans also continue to prove that they've learned nothing from last year's bank failures. The bills before us would allow large banks like Wells Fargo or Silicon Valley Bank to appeal and delay addressing compliance shortcomings identified by their examiners. These issues must be addressed immediately. Otherwise, millions of consumers will be harmed, or there will be more turmoil when these banks suddenly fail. This package would also make it easier for bank regulators to rubber stamp proposed bank mergers and encourage regulators to ignore concerns from the public. Now, on to housing. Republicans are proposing bills that outsource this committee's work and responsibilities while duplicating certain housing benefits for higher income veterans. Solving our nation's worsening housing and homelessness crisis should be the #1 priority of this committee. Yet, committee Republicans are ignoring this crisis and advocating for spending cuts that harm the stability and well-being of our nation's veterans. I'm pleased, however, that we are considering Congressman Sherman's bipartisan bill, the Housing Unhoused Disabled Veterans Act, which would ensure homeless veterans, including those who may have higher incomes, can access supportive housing through the HUD-VASH program while preserving critical rental assistance for the lowest income homeless veterans. We also have the Yes in My Backyard Act, led by Representatives Kilmer and Flood, with Ranking Member Cleaver and Congresswoman Pedersen as original co-sponsors. This bill is a welcome first step in the federal government's effort to track local progress in reforming restrictive zoning policies to increase housing supply. So I hope we can work together to further strengthen the YIMBY Act. Today, Republicans are also ramping up their anti-SEC agenda by proposing bills that would hamstring SEC staff's ability to provide clarifying guidance to registrants, politicize non-controversial auditing standards, abandon investors in the event of a market disruption gut system in place to identify fraud and manipulation within the stock market and leave investors in the dark about cybersecurity attacks that would significantly impact the companies they're invested in. The contrast is clear. While Republicans destroy, and derail, Democrats continue to fight to strengthen our economy and put people over politics. Mr. Chair, I urge you to withdraw these problematic bills so we can get back to the drawing board. And I yield back.
Pursuant to notice, I call up H.R. 758, the Promoting Access to Capital in Underbanked Communities Act, introduced by myself. The clerk will report the bill, which was distributed in advance.
H.R. 758, a bill to require appropriate federal banking agencies to establish a 3-year phase-in period for de novo financial institutions.
Without objection, the bill is considered read and open to amendment at any point. I have an amendment in the nature of a substitute, copies of which have been distributed in advance. The clerk will report the amendment.
Amendment in the nature of a substitute to H.R. 758, offered by Mr. Barr of Kentucky. Strike all after the enacting clause and insert the following. Section 1, short title.
Without objection, the amendment is considered read and will serve as base text for purpose of amendment.
Object. Object to treating the ANS as base text.
The amendment will be treated as a first-degree amendment. I now recognize myself for 5 minutes. Since the passage of Dodd-Frank, only 72 new banks have been chartered. In contrast, in the 14 years preceding Dodd-Frank, more than 2,300 banks were formed. Furthermore, according to the FDIC, only 60 new banks have been chartered in the past decade. In contrast, more than 2,000 banks were formed between 1990 and 2008. The result of this almost complete halt of de novo bank formation, along with consolidation stemming from increased compliance costs, ballooning capital requirements, and bank regulators' negative posture on healthy mergers and acquisitions, has been an increase in banking deserts in the United States, specifically in rural areas. These banking deserts have meant that many Americans are pushed out of the reach of the financial system. To better serve families and small businesses in these local communities, it is paramount that we restore dynamism in the system, including through new bank formation and increased competition. What we're talking about are the small community banks that members of this committee on both sides of the aisle for years have said we all support. The Promoting Access to Capital Act takes steps to do exactly that by providing flexibility to promote de novo formation, new bank formation, to provide competition to bigger banks. This legislation provides for a 3-year phase-in period for de novo financial institutions to meet federal capital requirements. It lowers the community bank leverage ratio, or the CBLR, for rural community banks to 8% from 9% during the first 3 years of operation. So just a 1-point reduction as authorized by federal law in S 2155. It requires the federal banking agencies to promulgate rules setting the CBLR lower for the first two years of operation to allow a phase-in period. It removes some restrictions to allow federal savings associations to make agricultural loans, removes the ag loan concentration limit, requires the federal banking agencies to conduct a joint study on trends in de novo financial institutions as well. Additionally, the study included in this legislation was a result of bipartisanship between my Democratic colleagues and myself. Community banks are a key source of capital for individuals, homeowners, and small businesses. Community banks, small community banks, are the key source for new business formation and entrepreneurship in this country. They are the pillars of their community, and they can meaningfully contribute to the economic prosperity of our country, especially in areas where they operate. And these community banks are critically important in rural and underserved areas. So, bottom line, we need more community banks. And that means more de novo bank formation to keep this important segment of the banking sector prospering and ready to serve Americans in urban and rural areas. This is something that members of this committee on both sides of the aisle have professed for years to support: small community banks. This vote is going to be a test about whether or not the rhetoric actually matches the voting record. Do you truly support small community banks, or do you not? This bill will create the record to decide whether or not members of this committee actually support community banks. And I would argue further, for financial stability, the key source of strength of our financial system is its diversity. If you are a critic of too big to fail banks, if you don't like large banks, why would you oppose creating more competition in the banking sector? This bill gives members the opportunity to vote in favor of more competition, more new bank formation. And to the extent healthy mergers need to happen because of distress in the mid-size or regional banking sector, if there is going to be consolidation because of various pressures in commercial real estate, or because of interest rate risk, or because of technological investment requirements, this is the way to backfill, to provide more diversity into the system with new bank formation in the form of de novo charters. With that, I urge my colleagues to support this legislation, support new bank formation, support providing financial services to banking deserts, to underserved parts of our country, so that Americans can achieve the American dream. And with that, I yield back. Is there further debate? Are there any amendments or further debate?
There is further debate on this legislation, so I strike the last word.
The ranking member is recognized for what purpose?
To strike the last word.
The gentlelady is recognized.
Thank you very much. I'd like a colloquy with the chair about this legislation. I am very interested in the expansion and development of what is being termed as novo banks, because what we find with the minority banks is we've lost a lot, and oftentimes that is referred to as, We have the larger banks who want a merger, and so it is not completely a loss, but we support the merger. What I want to create with you this conversation about, what are you doing relative to perhaps opening up an opportunity for these so-called novo banks to fail because of some new capital requirement, that lack of capital requirement that you're requiring?
Will the gentlelady yield?
Yes, I
So that
do.
Thank you for the question. Good question, very good question. And we have engaged with the state bank supervisors, other regulators about this very question. First of all, I would say that the lower capital requirements for a brand-new bank is specifically authorized, and we're not saying no to new capital, but we're providing that at the lower bound that is already authorized under law. Second, it stands to reason that you would have lower levels of capital when you just get started, so that you have time to build up the capital. You can't get more capital unless you start somewhere. That's what this is. Third, the reason why there's not a lot of de novo charters right now, new bank formation, is because the initial capital is so burdensome, it precludes the ability of new bank formation.
Will the gentleman yield? Now, you can't have it both ways, and I'm trying to find out whether or not you reduce the amount of capital that is needed, or they will start right where capital is required. Which is it?
So, the gentlelady yield?
I yield.
So what we do is we tailor the capital requirements. There's a phase-in. At the end of the 3 years, they have to be well-capitalized. They have to get there. But you have to give them an on-ramp. This is an on-ramp to start. One of the major impediments for new bank formation is that you basically give them the same requirements at the day one as incumbent banks. This allows them to phase up, and if they don't get there, they don't get there, and they lose their charter. But I would say, let me submit one other major point. The gentlelady raises a very legitimate issue, and that is safety and soundness. We don't want more bank failures. But by the very nature of what these institutions are, they're de novo charters, they're brand new banks, they're tiny little infant banks.
Will the gentleman yield?
It is the exact opposite
Will
of
the gentleman yield?
systemically important banks.
Will the gentleman
Yes.
yield?
Yes, I will.
During COVID, we had something called PPP, and it helped our minority banks, it helped our small businesses so very much. If there was a way by which we could help our new banks that you're advocating for and I'm advocating for, by doing something similar to PPP with an on-ramp appropriation of some kind to ensure that they don't fail early on in the first 3 years, would you give some consideration to supporting that? Because I want to help these small banks get started.
Will the gentlelady yield?
Yes.
I'm not sure exactly what she's proposing a PPP for banks, but what I would just say is this, is that, to reiterate, these are the exact opposite of systemically important institutions. There are going to be failures of small banks, and they may be acquired through healthy mergers. But the idea is the regulatory barriers, the barriers to entry are so high that we don't see the kind of dynamic new bank formation activity that is required for a healthy banking system that provides the very competition that we want to larger institutions. So that's why we support this on-ramp. If any of these banks were not to get to the capital that they are required to get to after 3 years, or if there were bank failures, the good news is these are such small banks that they don't pose any systemic risk to the system whatsoever.
Reclaiming my time, I'm going to postpone my amendment and have further conversation with you. With that, I yield back.
Gentlelady yields back. The gentleman from Massachusetts is recognized.
Mr. Chairman, I'd like to strike the last word.
The gentleman's recognized.
Thank you. Here's my problem. The consolidation that we have seen, and the chairman correctly identifies the lack of de novo or new banks coming online, but But that has largely been caused by the failure of smaller banks and a flight to safety and soundness by depositors and investors. When we saw Silicon Valley Bank, a more regional type bank, larger than some of our very small banks, when we saw Republic Bank, when we saw others, the reason they went under, the reason those banks failed is because their depositors recognized that they weren't sufficiently capitalized to withstand the disruption, and there was fear. There was fear among the depositors, the investors, and a lot of them were venture capitalists, and they moved their money in a heartbeat. And so what happened was the money from the smaller banks fled to the larger banks. And we were forced to allow some bigger banks to actually take over the smaller banks, making them even bigger. So what this is doing, you describe it as an on-ramp, I describe it as a breakdown lane. You're allowing these small banks to be less robust. You're allowing these smaller de novo banks to be less resilient, weaker. And then you're saying in 3 years they'll actually be well capitalized. They need to be well capitalized from day one. From day one. If people and businesses are investing in, and communities are investing in these banks, their money needs to be safe. The structure of these de novo banks has to be strong. You're actually allowing them to be weaker than the law would require them to be. And we've done this by experience. We've seen periods of massive bank failure in this country, and we've established a set of standards that has been very good in the most part in securing depositors' funds through the FDIC and other. We will go in and rescue depositors, but we have an insurance program that actually covers that eventuality. The other thing that's going on in this bill is your bill limits regulatory review of the business plans underpinning these de novo banks. So these de novo banks would have to submit a business plan to show that they're viable, even though you're allowing them to be weak by reducing the capital that supports their operations. You're allowing them to in their business plans
Will the gentleman
have
yield?
no, I want to just, please, let me just finish my thought here. You're abbreviating the review period to 30 days. So this is a shotgun wedding. You're basically saying, okay, here's a de novo bank. They're going to have less capitalization. They're going to be weaker. And you're giving the agency the ability to review this for 30 days. Otherwise, if you don't finish the review of this new bank with weaker standards, they're going to automatically be approved because the 30 days goes by. So at the end of 30 days, whether they have a viable plan or not, and you're already allowing them to come in with less capital than regular banks that exist now, they get approved, automatically after 30 days, regardless of what the review says. And then finally, it eliminates the cap on agricultural loans made by thrift banks that was established back in the 80s when we had another period of major crisis here in this country with the failure of savings and loans during the 1980s and 1990s. So Congress came in, we supported the regulation that actually would prevent that concentration from occurring. So all of these protections you're eliminating with this idea that we're going to create, baby banks or de novo banks, new banks that are going to have less protection.
The gentleman's time has expired.
Yeah, okay.
Gentleman's time has expired, and for what purpose does the gentleman from Tennessee seek recognition?
Move to strike the last word.
Gentleman's recognized for 5 minutes.
I'd like to yield my time to the chairman.
Well, I appreciate it, and I thank the gentleman from Massachusetts for engaging in the discussion and offering a general support for the idea of new bank formation. Let me just say, I respectfully reject the premise of the gentleman that these new banks would be undercapitalized. They would certainly have an on-ramp. They would not have to have the same level of capital as large banks immediately. But the idea that we would allow under this legislation institutions to have insufficient capital is something that I just respectfully disagree with. We allow an on-ramp, as would be expected, as one would expect. And by a certain time, 3 years, they have to achieve a certain level. The other point is, the gentleman is just incorrect when he says it would allow the banks to be capitalized less than what the law requires. The community bank leverage ratio in the law permits the regulators to lower to 8. We in this bill allow it to go, the community bank leverage ratio to 8 as specifically authorized in the law. And then the argument that the gentleman makes that there was a flight to quality. This is a good point that Mr. Lynch makes, because that's exactly what we saw after the instability of Silicon Valley Bank. We saw, especially in mid-sized banks where you did have uninsured depositors, move to too big to fail banks. This is actually precisely the problem that we're trying to fix, right? Regulatory tailoring for community banks and mid-sized banks and new banks. The idea that we would have one-size-fits-all regulations on all banks doesn't make sense, because as banks become bigger and more complex, they become more systemically important and more systemically risky. New banks are the exact opposite of that. They are not interconnected to the global financial system. They're typically geographically confined. They have a smaller number of customers. They're less interconnected to the system in profound ways. And so the idea that we would impose the same level of capital, the same level of regulations, the same limits on agricultural loans on these tiny, small new banks as we do for large banks doesn't make sense. And one of the reasons why you had the flight, one of the reasons why you had flight is because these institutions were deemed as not being able to sustain themselves because there's so much regulatory pressure. That's why there's a impetus for healthy mergers out there to deal with the regulatory complexity. So the idea is that we want to tailor the regulations so that these banks, these smaller banks, can compete and get to the point where they can be, sustainable going concerns. The problem is now no investors are investing because the regulatory hurdles, the barriers to entry are too difficult. What we want is we want less deposit flight to the too big to fail banks so that too big to fail banks don't get bigger. This is the remedy for that. The remedy is more banks, more competition. If you don't create that gateway, that entry point, then you will get what you fear, which is a banking system that is dominated by GSIBs, by too big to fail banks or large regionals, because no small bank can survive the regulatory pressure. I think we share the same goal.
Well,
which is,
will the gentleman yield?
I will yield to you. I think we share the same goal, which is more competition to the system. It is Mr. Rose's time, but how can we create that competition if you don't allow new bank formation? And I will yield back to the gentleman from Tennessee.
And I will yield.
Thank you, Mr. Rose. I appreciate your courtesy. I get it. And I love my small banks because they're paying attention to the people that we really do care about, right? And they're the ones invested in our communities. I love my small banks, my community banks. But what I'm fearful of is when there's a disruption, when there's concern out there, the gentleman correctly stated, this is a competition. And what's happening is the depositors are all running for their lives, and they're going to the banks that have the most capitalization, the safest banks. It's a flight to safety. And that's going to happen here. That's going to happen.
Will the gentleman yield?
I yield.
I yield for the question. Well, which is it? Do we just want strong too big to fail banks? Or do we want some new banks to come in and compete with them? The gentleman's time has expired, so unfortunately,
I yield back.
Ms. Scott?
Gentleman yields back. For what purpose does the gentleman from Illinois seek recognition?
Strike the last word.
Gentleman's recognized.
Yeah, I'd like to direct everyone's attention to a very thoughtful set of articles in the Wall Street Journal about the struggles of small rural banks. The problem is not capital, initial capital or anything like that. The problem is the profitability of the business model. And there are simply not many profitable loans to be made in a dying small town, all right? And it's just that rough. In fact, the only profitable business model, according to the Wall Street Journal articles, were to accept deposits from the small town and then invest them in loans that are made at the nearby larger city, which is sort of indicates the real struggle here. It's not capital, it's the profitability of the business model. It's not, I don't believe it is not regulation that's doing it. It is the profitability of the business model of a small bank. And it's a tragedy, and it is something that we should lean against as hard as we can. But simply, the solution to this is not to have a large number of undercapitalized small rural banks. The other thing we have to be careful of is the falling again into the belief that small banks can never be dangerous. If you look at the savings and loan crisis, that was the failure of thousands of smaller institutions which were undercapitalized and got on the wrong side of interest rate bets, and then all sorts of bad things happen. But the lesson there for the taxpayer is that to bail out the savings and loan institutions by the thousands cost the federal taxpayer about 1.7% of GDP. It was a huge bailout the taxpayer never got repaid for. That's in contrast to TARP, where the taxpayer was fully reimbursed at the end of the TARP bailout. So don't make the assumption that nothing dangerous can happen with large numbers of small banks. Though the chair is correct that a small number of small banks have very limited risk. But we have to come up with something to improve the profitability of the small bank business model. And that's a tough one because, doing that without tapping the taxpayer subsidies of some kind is going to be really difficult. Anyway, that's it. And I'm happy to yield my time to the ranking member or to Mr. Lynch if he'd like.
I thank the gentleman. And I just want to point back, and I agree completely with the gentleman from Illinois has said. The idea that these small banks, there's no systemic consequence. Just think back to when, Silicon Valley Bank, Republic Bank, and others got in trouble. The FDIC had to step in. They conducted the sale as best they could, but unfortunately, the larger banks got even larger. And the emergency action that was taken to guarantee all depositors, even those that were invested beyond the $250,000 that FDIC normally insures, they had to calm the markets. They had to step in and say, okay, we're going to take extraordinary action here to make sure this does not spread. So it was largely at that point the action of the regulators to strengthen the safety net that helped us address that problem that was caused by several regional banks. So the consequences of these smaller banks can reverberate through the system. When there is fear among the depositor base. So. With that, I yield back the final minute to Mr. Foster.
And if she wishes, I yield my remainder of time to ranking.
Thank you very much, Mr. Foster. I only have a few minutes here, but this discussion that I'm creating is about what is happening to minority-owned banks in this country. Now, I don't agree with everything that's in this bill, because it really only directs correction to agriculture, to small banks in rural communities for the most part. But what we've got to understand is the larger banks that we complain about all the time, who, number one, do not treat minorities and women fairly, who basically create more interest rates, higher interest rates for minorities, despite the fact they have the same income,
Time has
same
expired.
debt, on and on and on. We've got to start to deal with the problem.
The time has
We
expired.
talk about access to capital, et cetera,
The gentleman's
et cetera.
time has expired.
And so while this does not take care of all of the concerns, I'm going to have to deal with
For what
I
purpose
do
does
to
the
open
gentleman
up
from
these
Texas seek
opportunities.
recognition?
I yield
Chairman,
back.
I move to
Gentleman,
strike the last word.
gentleman's recognized.
I give my time to the chairman.
Thank you very much. Let me address again this argument that these would be undercapitalized banks. That is not what the legislation provides. The legislation actually specifically authorizes the bank agencies, the federal banking agencies, to set the ratio. The federal banking agencies have a mandate to ensure, the prudential regulators have a mandate to ensure the safety and soundness of the system and safety and soundness. We do not repeal the safety and soundness requirement here. That is not what is authorized in the bill. We do not authorize the undercapitalization of new banks. We simply say that the heightened capital requirements for more mature banks don't apply in the first 3 years. And it gives the federal banking agencies discretion to set in the first 2 years of the 3-year period some tailoring by setting lower community bank leverage ratio, but within the existing framework, within the existing law of tailoring. Now, as to the gentleman from Illinois' point about profitability, it is true that in distressed parts of the country, and not just in rural, but in urban parts of this country, that it's difficult sometimes for banks to have the loan demand and to have the profitability because the economy is distressed. But the whole idea is that we need to address the problem of distressed communities in both urban and rural areas. I represent urban banking deserts. It does. It does. This bill, opposing this bill, denies new banking services to urban, underserved neighborhoods. This bill is not just about agricultural. It is not just about agricultural and rural areas. This would allow for new bank formation in banking deserts all over this country, urban, rural, suburban. So if you truly care about new bank formation, if you truly care about dealing with banking deserts, if you want to bring capital, private capital, into distressed neighborhoods, this is the way to do it. And by the way, on this argument about profitability and the savings and loan crisis, the analogy, first of all, there have only been 60 de novo charters in the last decade. We're not talking about creating this huge new segment of the financial ecosystem that's going to bring down the whole system. We're talking about only 60 new charters. That's why we need more charters, number one. But number two is the phase-in requirements of these regulations actually allows these new banks to be profitable. If that's what you care about, if you want to make sure they're profitable, the phase-in of the regulation allows these new banks to actually achieve profitability sooner. So that's why it's justified. So again, and final point, once again, it stands repeating. This is not just about rural underserved banking deserts, it's about urban as well. I care about my urban distressed communities just as much as I care about my rural underserved communities. That's why the bill is neutral with respect to that. It's about new bank formation to deal with bank deserts all over this country and getting these banks up and going so that they can be profitable as soon as possible, so that they can phase in that capital and so that they can serve those underserved communities all over this country. With that, I'll yield back to the gentleman from Texas. I'll yield back to the gentleman from Texas.
And I yield my time back to you.
Okay, gentleman yields. For what purpose does the gentlelady, Ms. Garcia from Texas, seek recognition?
I move to strike the last word.
Gentlelady is recognized.
Mr. Chairman, well, I think you've got a laudable goal. I guess my concern is what may happen if a large bank, a conglomerate, one of the national banks, creates and starts one of these subsidiary a subsidiary of a de novo bank just to get less capital, just to get the foothold somewhere, and then comes in and swallows them up. It's sort of similar to some of the concerns that many of us have had when some corporations, form and start a small business so that they can get some of the small business benefits. And then as soon as that small business starts flourishing, they come in here and take over that small business. So I've got a lot of concerns and wonder what guardrails are in place to protect a truly small bank. And with that, I know that
Will the gentlelady yield
not at this time.
so I can answer that
I
question?
would yield to the ranking member.
Very much. This discussion is very important. It is very important because we have watched the loss of banks in minority communities, in Black and Latinx communities, and we have done nothing to try and ensure their success by way of legislation. This bill does not absolutely deal with that. We're not talking about lowering capital requirements. I'm not talking about not caring about the fact that minority banks should have adequate capital and there should be profitability and all of that. What I'm saying is this. We can't keep saying that minority banks cannot serve minority communities. We've got to get more help in minority communities. The big banks keep us from being able to get the loans to small businesses. They continue to charge higher interest rates. They continue to exclude in so many different ways. I am tired of being victim to the big banks of America. So the question becomes, what can we do except talk about they can't be a bank because they don't have enough capital? What I want to know is, for example, when they make applications or whatever the process is for them to become a bank, if they need more capital at that point, do you extend it for another 90 days for them to go out and get more capital? Do you look at what we're giving to CDFIs and say maybe we should direct some of that to the smaller banks in the same way that we're giving to the CDFIs, because that's why we give to the CDFIs, because the banks do not lend to minorities and to women, et cetera. So what I'm saying to you, and I don't support not having enough capital, but what I'm saying to you is I'm sick and tired of not coming up with the answers that we can do for minority communities, particularly with minority banks, who, if they had the capital, if they had the resources, they would be lending to us, because the big banks don't care about us, and they don't lend to us, and they don't do small. But this bill really does not deal with it properly. I've raised the issue, and I'm not going to support the bill, but I want my members on this side of the aisle and on the opposite side of the aisle to understand we cannot keep talking about how we solve problems for everybody but the minority banks. I would love to solve the problems of the rural banks, but you give them preference even in your bill. And so I'm not buying into we can't do anything for minority banks, even if it means doing kind of what we did with PPP, et cetera, et cetera. And so with that, I just want you to know this is the beginning of a new conversation that I'm having on with my colleagues also about what we can do for Novo banks, and not only rural, but urban banks also. And I yield back the balance of my time.
I reclaim my time, and Mr. Chairman, I think you had wanted to respond to something.
Well, yes, I appreciate.
I only have a few seconds, but I'd be happy to yield now.
Well, just thank you. The gentlelady yields. The point here is that if you want competition for the larger banks, I wouldn't worry about larger banks starting a new charter. I would worry about larger banks acquiring other banks, perhaps. But the whole idea here is you create new entrants into the marketplace to create more
But does your
competition
bill
for
have
those
any
institutions
guardrails to
that you.
prevent that from getting a big national bank to come in?
Well, you're never going to
in
get
front?
new banks if you continue to have these impediments. Gentlelady's time has expired.
Thank you.
The
Yield back.
gentlelady from Texas, Ms. De La Cruz, for what purpose does she seek recognition?
I move to strike the last
The gentlelady
word.
is recognized.
I move to strike the last word and yield to the chairman.
Well, thank you. I appreciate the gentlelady yielding. And just to finish the point, again, there has been only, 60 de novo charters in the last decade, whereas in the decade or so before, there were 2,000. The dynamism of new bank formation, something has happened. Something has happened. And that what has happened is that there are regulatory barriers to entry here. And so the idea is not to have undercapitalized community banks, it's to give them an on-ramp. And yes, this is about as much as it is about rural underserved banking deserts, it's about minority-owned banks. It's about urban banks. It's about distressed neighborhoods all over this country that don't have those community banks bringing private capital in to provide for those new startup businesses and homeowners. We want more banks in those banking deserts. And so the idea that you would say, well, I'm not going to support new banks coming into urban distressed neighborhoods because I'm worried that they're undercapitalized, they're not going to be undercapitalized. The bill doesn't say that they have to be undercapitalized. It just allows for an on-ramp so that they don't have to have the same capital requirements that J.P. Morgan has or Bank of America or Citi on day one relative to their size. And it's within the framework of the community bank leverage ratio. So I just think, look, if you really truly care about these small community banks, here's your chance. This is your opportunity. If you care about banking deserts in urban, rural, whatever, this is your chance to actually do something to help the problem. So with that, I will yield back to the gentlelady from Texas.
Thank you. I yield my time.
For what purpose does the gentlelady from Ohio seek recognition?
Move to strike the last
The
word.
gentlelady is recognized.
Mr. Chairman, as I'm listening to this dialogue, it seems like we need to listen more to each other. And I'd like to yield time to the ranking member to finish her thoughts.
Thank you so very much, Ms. Beatty. Let's be clear. Number one, we support rural and urban banks, small banks, new banks being able to develop, create, and operate these small banks. I do not support that they have less capital. I do not want to set them up for failure. But what I want to stop doing is saying that there's no way that we can do this for minority banks. No way can we do this for rural banks unless we reduce the capital and set them up for failure. What I'm saying is we need to, and I've started to think about new ways to deal with an issue such as this. For example, if they do not have sufficient capital, when they make application for new banks, can we give them an extension of time to go out and find some more money for 90 days or so, instead of saying, no, you can't be a minority bank? Can we look at what we do for CDFIs, who we give money to do what the minority banks and small banks can't do? Can we direct capital to new banks that are starting up so that the government is giving and supporting the ability for these new banks to meet the capital requirements? Can we offer loans to the new banks that they have to repay them over a period of time so that they meet the requirements of capital and still have some of what is in this bill that say you have 3 years to maintain your bank with sufficient capital, et cetera, et cetera. I'm opening this discussion, again, because I'm sick and tired of minorities being cut out of all systems in government, including the banking system, because we continue with the old rules, the old regulations, without modifications, without putting them at risk. That's all I'm saying. So I am going to oppose the bill. I don't just want to study. A study is a nice way of saying you're doing nothing. What I want is, I want a commitment, even though I'm not going to support the bill, that you will work with me to find ways by which we can have small and minority banks in rural and urban communities become banking institutions that will lend to the people who are excluded.
Will the gentlelady yield?
I yield.
Thank you. I appreciate the gentlelady yielding, and to her point. Oh, I'm sorry. I apologize. Okay.
I think the gentlelady, I'll be quick, there'll be time left. Look, the banking has changed in this country drastically. I used to go to the bank every week to cash checks and all that stuff. My kids, I don't think they've been at the bank twice in their lifetimes. They're in their 20s now. They went to get traveler's checks to go on spring break. That's it. Everything else is, so banking has changed, like Mr. Foster said earlier, the whole industry has changed. The banking model in some of these small banks has made them non-viable. And we have to figure out how to strengthen the ability of new banks to come into being. What I'm saying about this bill, though, is, number one, it requires de novo banks to have less capital, 8%, okay? I'm not saying that's technically undercapitalized. I am saying that it is by definition less capitalized. And in times of stress, the smart money is going to move to a safer position. And you're creating weaker banks that will experience runs on these banks. The banks that are least able to sustain themselves and to survive, you're creating a bank run in that bank.
Will the gentleman yield on that point?
It's not my time.
Just really quickly, the deposit outflows were mainly in the mid-sized banks, not the community banks, because those deposits were insured. The mid-sized banks saw the outflows because they had uninsured deposits. These are banks that have insured deposits. With that, I yield, gentlelady's time has expired. The gentlelady's time has expired. For what purpose does the gentleman from Missouri seek recognition?
I move to strike the last word, Mr. Chairman.
Gentleman's recognized for 5 minutes.
Thank you. What a discussion here this morning. Trying to fight to be able to allow new banks to be created, to be able to allow banking deserts, both in rural and urban areas, to be able to have access to capital, access to funds, be able to put their funds in an insured institution where they're safe. And we're arguing over that? Really? If there's something wrong with the structure of the bill, well, that's fine, but the very concept, I think the ranking member even agrees with the concept. So let's talk about it a minute. Somebody said a while ago, we need guardrails in place. That's what regulators are for. Regulators are supposed to put the guardrails in place. There's so many rules and regulations in place right now. That's one of the reasons you have no more small businesses, small banks. They're going out of business because they can't comply with all the rules and regulations that are there now. It's so expensive to stay in business that their business model at that size can't exist. So there are guardrails in place, plenty of them, almost too many, to be quite frank. Is 8% the right number of capital, about amount of capital? I'm a big believer in capital. The more capital, the more safe the bank is. So I'll never argue for that point, but I think 8% is a good place to start. And I think if the regulators on a new bank come in on a 6-month basis, they can look at that bank and say, well, you're growing fast enough, you need to have more capital. Or, especially in rural areas, there's not going to be as much growth, so therefore you're not going to need as much capital as quickly as you would if you were in an urban area, for instance, or a suburban area. So, but the regulators need to be watching this and doing their job, which they haven't been doing, quite frankly, for a long, long time, as evidenced by last year's debacle of the 3 banks that went under. But we need these small banks to start with small businesses. I sit on the Small Business Committee. And we had a business testify not too long ago. Said, look, we need small banks because that's where small businesses get their loans. That's how small businesses get started. They go to a small bank or a small entity, a financial entity of some kind, to get their funding. I've sat here as the chairman of this subcommittee. I've met with all of the executives of all the big banks in this country. They don't want to make small business loans. Don't even go there, because they've even told me behind closed doors, we don't want small business loans. That's not our business model. We want small banks to make the small business loans, and as they grow, yeah, we'll take them over. We're glad to do that, because then you have sorted through all the small businesses that are problems, that have problems getting off the ground, and as a result, you've got a viable business, and they'll take that and they'll run with it. That's the banking model of today. Now, what do we want to do with regards to access to capital in this situation? Again, as the vice chairman today of the Small Business Committee, and we have the chairman sitting here off to my left, the Small Business Administration has tried to expand their direct lending program on one of their programs. It is a disaster. It is a disaster. They have the EIDL program, Emergency Injured Disaster Loan Program, that has a past due rate, a loss rate, fraud rate of almost 40%. Let me say that again, 40%. The government is a disaster when it comes to making direct lending, and now they want to get into this business again. So we need to have the small businesses be able to have access through the private sector. So that brings us to the fintech folks. It's wonderful. You have online lending. You have the ability to go online. If you can't get something at your local bank, you can go online and punch in some buttons and you get some money. But again, we found out in the PPP program, that's where all the losses were in the PPP program. The banks and credit unions did a fantastic job. Almost zero loss due to fraud. Almost all the fraud was in a handful of fintech companies that did not do their job of underwriting the risk. And as we saw during the pandemic, because they weren't capitalized, guess what? They went down. And so what do we do whenever we have a problem with our economy? Whenever the economy is under stress, what do? First thing we do is run to the banks to make sure they're shored up, to make sure they can withstand whatever hit is coming in our economy. They are the rock on which we build our economy. And when you undermine them, you undermine our economy. And what the chairman's done today with his bill is allow for the ability to continue to strengthen our economy, to strengthen our communities, whether they be rural or urban, in a way that is going to help them develop those communities and provide lifestyles and jobs for those communities in a way that's going to help our economy survive. Ladies and gentlemen, this is a very, very important bill to your community at home, to the people you represent, to the people of this country who make it work.
Gentleman's time
Small
has
businesses.
expired.
And with that, I yield back.
Thank you, gentleman. Yields. Is there further debate or amendment? Seeing that there is no further debate, no amendments offered. There being no further discussion or amendment on the bill, the question now occurs on the adoption of the amendment in the nature of a substitute offered by the gentleman from Kentucky, me. All those in favor shall signify by saying aye. Aye. Those opposed shall signify by saying nay.
No.
In the opinion of the chair, the ayes have it. The question now occurs on ordering the bill H.R. 758 as amendment reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay.
Nay.
In the opinion of the chair, the ayes have it.
Recorded vote is requested.
A recorded vote is requested. All those in favor of a recorded vote, raise your hand. A sufficient number having raised their hand, a recorded vote is ordered pursuant to subsection C5 of Rule 3 of the committee rules. The vote on this question is postponed. Pursuant to notice, I call up H.R. 3161, the CDFI Fund Transparency Act, introduced by the gentleman from Tennessee, Mr. Rose. The clerk will report the bill, which was distributed in advance.
H.R. 3161, to amend the Rural Community Development and Regulatory...
Without objection, the bill is considered read and open to amendment at
I
any point.
object to treating the ANS as base checks. Is this so?
Yes, but
The gentleman from Tennessee has an amendment in the nature of substitute, copies of which have been distributed in advance. The clerk will report the amendment.
Amendment in the nature of a substitute to H.R. 3161.
Without objection, the amendment is considered read and will serve as base text for purpose of amendment. The gentleman from Tennessee.
I object to treating the ANS as base text.
The ANS will be treated as a first-degree amendment. The gentleman from Tennessee is now recognized for 5 minutes.
Thank you, Chairman Barr. H.R. 3161, the CDFI Fund Transparency Act, is titled to reflect the purpose of the legislation. I'd like to thank Representative Pedersen for co-leading this piece of legislation. This bipartisan bill would require the Community Development Financial Institution, or CDFI, fund director to testify in front of this committee on an annual basis at the discretion of the chair. Currently, there is no requirement for the director to testify before Congress, which hinders our ability as a committee to conduct oversight and provide transparency on behalf of our constituents and the American people who utilize the CDFI fund's services. The CDFI fund provides economic opportunity in rural and disadvantaged communities across the country by providing financial assistance and information to their member institutions. That's exactly why it's necessary that Congress has oversight over the CDFI fund and the ability to ensure that it is appropriately utilizing taxpayer dollars. With certified CDFIs in all 50 states, the District of Columbia, Guam, and Puerto Rico, I believe it is in the interest of my fellow members of Congress on both sides of the aisle to be able to engage in annual oversight of this vital program. When speaking with my constituents who depend on the CDFI fund, I have heard countless stories of how the CDFI fund decisions lack clear reasoning and their processes, frankly, are extremely confusing. In August of 2022, I, like all of my colleagues, was traveling across Tennessee, and I first experienced this when I visited Trust Federal Credit Union in Chattanooga, Tennessee, actually outside of my district, but I was there visiting and speaking to financial institutions. Their CEO explained how receiving recertification from the CDFI fund has become an unnecessarily burdensome process. And for those around back in the late summer, fall of 2022, many of you experienced a similar problem as you saw CDFIs not being renewed in the normal course by the director and by that program. As they were working through the recertification process, the Treasury Department informed them that they had received a grant through the Emergency Capital Investment Program, or the ECIP program, in December of 2021. However, in June of 2022, the CDFI fund stated that Trust FCU had issues with their recertification application and would not be certified until those were fixed, therefore holding up the ECIP funding that this financial institution had received. Trust FCU had already been certified once and had been a successful CDFI for 5 years at this point. Yet when they asked the CDFI fund what those issues with their recertification was, there was not a single response back. It was not until August of 2022 that the CDFI fund finally explained why their application was still pending. And frankly, I've heard that explanation, that information related to me, and it was an issue that frankly was beyond the control of this credit union to resolve. In the meantime, their ECIP funding was put on hold, and Trust Federal Credit Union had to take out a line of credit to close on the funds, costing the credit union a significant amount of money. And I will just tell you as a little bit of background to this, those funds were going to allow the credit union to open a branch in a minority community of Chattanooga that was vastly underserved, was essentially a banking desert. And so that was being held up by this kind of nonsensical issue with respect to their recertification. When I heard this story, I could not believe how the CDFI fund was treating its membership. I worked with Mr. Barr, who was already engaged on this issue, to reach out to the CDFI fund and highlight the issues that I had heard about. However, we received similar responses from the ones that Trust Federal Credit Union had received. It is for this reason that I worked with Ms. Pedersen to launch this bill and bring oversight to the CDFI fund. Thank you for, I think this is a good bill that will allow members across the spectrum to be able to find out what's happening at the CDFI fund and make sure that it is accountable to the taxpayers and to Congress. And with that, I thank the chairman, and I yield back the balance of my time.
The gentleman yields. For what purpose does the gentleman from Massachusetts seek recognition?
I believe Ms. Pedersen is a
sorry.
co-sponsor, and I would yield to
For
her.
what purpose does the gentlelady from Colorado seek recognition?
I just thought you got my state wrong. Thank you, Mr. Chairman. The community development.
gentlelady's recognized.
Oh, sorry, I moved to strike the last word.
The gentlelady is recognized for 5 minutes.
The Community Development Financial Institution Fund plays a critical role in ensuring access to credit and capital is available to all of our communities, particularly minority and economically distressed communities. Promoting and supporting CDFIs has been a bipartisan venture, and through this partnership, we've seen this collection of mission-driven financial institutions grow from just over 800 CDFIs in 2013 to nearly 1,500 CDFIs today, operating in all 50 states in the District of Columbia, Guam, and Puerto Rico. And with the growth of the CDFI community, it's also important that Congress maintains robust oversight over the Treasury's CDFI fund, and that's exactly what this bill does. The CDFI Fund Transparency Act would require the Treasury Secretary or their designee to testify regarding the operations of the CDFI fund on an annual basis before the House Financial Services Committee and the Senate Committee on Banking, Housing, and Urban Affairs. I want to thank my colleague from Tennessee for working with me on this legislation and your commitment to ensuring Congress's work on CDFIs remains bipartisan and forward-looking. I also want to recognize the work of my Democratic colleagues, especially Ranking Member Maxine Waters and Congressman Greg Meeks, for their work to lift up CDFIs and enhance credit opportunities for the communities that need it most. Your work over the past years, especially during the pandemic, has made a huge difference for the consumers, small businesses, and communities that need it most. I urge all my colleagues to support this bill, and thank you. I yield back.
The gentlelady yields back. For what purpose does the gentleman from Massachusetts seek recognition?
Very briefly, just strike the last word.
Gentleman's recognized.
Thank you, Mr. Chairman. I just want to rise in support of Ms. Pedersen and Mr. Rose. I think this is a very thoughtful piece of legislation, and it is sadly needed, as they have described in their testimony. So with that, I'll yield back unless one of the other members wants to take some of my time. But I congratulate those two members. Thank you.
Move to strike the last word.
Does the gentleman yield to the ranking member?
I do.
Oh, thank you very much. Mr. Chairman, this bill would require annual testimony from the Secretary of the Treasurer or their designee on the CDFI fund's operations. But this is a standard that you have not met this Congress. In fact, in addition to not holding any hearings focused on CDFIs or the CDFI fund, you have also failed to move any legislation to strengthen CDFIs and the communities they serve. In contrast, during my time as chair, we held a series of hearings so we could better understand the different types of CDIs we have, including CDFI banks, CDFI credit unions, and CDFI loan funds, and the ways they help provide financial products and services to underserved communities. I also advanced substantive legislation to support and strengthen CDFIs and other diverse and mission-driven lenders like MDIs. For example, I worked with then Small Business Committee Chair Nydia Velasquez to secure a $60 billion set-aside to allow community financial institutions, including CDFIs and MDIs, to deploy badly needed paycheck protection programs to small businesses. I then worked with Senator Warner, Ranking Member McHenry, other colleagues on this committee and in the Senate to secure an unprecedented $12 billion in capital investments and grants for CDFIs and MDIs in 2020, allowing them to expand and provide the support that all communities deserve. This includes the small businesses and businesses owned by people of color, which are the hardest hit during the COVID-19 pandemic. And I'm pleased that Treasury and the CDFI Fund worked hard to deploy these funds, and those who receive funds have leveraged them to provide further support to small businesses all across the country. Not only that, but we also passed bills with more broad bipartisan support, including a bill by Rep. Meeks to support MDIs, another bill by Rep. Beatty to codify Treasury's mentor protege program, and yet another bill by Representative Cleaver to improve the CDFI bond guarantee program. Unfortunately, just like the HUD and HUD Inspector General testimony bills we recently passed, Republicans are advancing yet another testimony requirement bill because they don't seem to have any bright ideas or real solutions on these issues. Mr. Chair, we've had statutory required hearings that you have not held this Congress. For example, we're required to hear from another Treasury office, the Office of Financial Research, once a year, and we have not had that hearing last year or this one. We're required to hear from the Treasury Secretary and Fed Chair every 6 months pursuant to the CARES Act, and those hearings have not been held of this Congress. Mr. Chair, you've had 1.5 years to hold a hearing on the CDFI fund, but instead this bill before us will require future chairs to do what you have not done. I assure you this bill is only needed to hold Republicans accountable, because when Democrats take over next Congress, we will absolutely hold hearings and move legislation to ensure CDFIs are thriving in this community, whether or not we're required to do so. Requiring one hearing on this issue is probably the very least we can do, and even that, this bill falls short by failing. Look, the fact of the matter is, I'm going to support the bill. The fact of the matter is that we're agreeing that there should be a CDFI hearing, and there are some other amendments that I have that I think will help to make this a stronger bill. But if in fact we are concerned about CDFIs, and the fact that we want to know more, that's okay. But we also have got to be concerned about how we strengthen them, how we make sure that we're giving them the kind of assistance over at the Treasury Department to ensure that they can be successful. Because again, this is the only thing that we have as an option to the banks who refuse to give small business loans. I yield back. Whoever's time this is, you got it back.
Mr. Lynch's time. Does the gentleman yield back? Gentleman yields back. Is there further debate or an amendment?
Mr. Chairman,
For what purpose does the gentlelady from New York seek recognition?
I have an amendment at the desk.
We will pause while the amendment is distributed. Not everybody yet. He's working on it. So should I go ahead? The clerk will report the amendment.
Amendment to the amendment in the nature of a substitute to H.R. 3161, offered by Mrs. Velasquez of New York.
Without objection, the amendment is considered read. The gentlewoman is recognized on her amendment.
Thank you, Mr. Chairman. The underlying bill offered by Representatives Rose and Peterson is a good idea, and I will be supporting. It requires the Treasury Secretary or their designee to testify on an annual basis about the operations of the CDFI fund. CDFIs are a critical component for the financial ecosystem for my community and for thousands of other communities across the country. There are 67 CDFIs across New York that have distributed more than $207 billion in funding. New York CDFIs have provided loans or investment for small and micro businesses, home improvements, and home purchases and commercial real estate. These awards have helped finance more than 17,000 affordable housing and 12,000 small businesses. CDFIs step up and help distribute critical pandemic funding during the course of the pandemic, often to small businesses and communities that were left behind by the bigger banks. Small businesses reported the greatest level of satisfaction with CDFIs and small banks. SBA's data also shows CDFIs were best able to reach underserved small businesses. CDFIs were the only type of PPP lender that performed above program average for small dollar loans less than $150,000, loans made in LMI areas, and loans made in rural areas. To help enable more small businesses recover from the pandemic, thanks to the work of President Biden and congressional Democrats, the SSBCI capital program was reauthorized and allowed CDFIs to expand their lending to eligible businesses. SSBCI programs present an opportunity for CDFIs to expand their lending to eligible small businesses, including to underserved small businesses and nonprofits, and through credit support. States, territories, and tribal governments have created programs poised to support billions of dollars in CDFI lending and are continually seeking active CDFI partners. Participating with an SSBCI can support its CDFI's mission of expanding economic opportunity for underserved communities and businesses by enabling the CDFI to underwrite larger and more challenging credits while lowering the CDFI's lending risk. As of June 2023, 78 individual SSBCIs supported lending programs targeted for deployment or administration by or with CDFIs, totaling $3.4 billion, or 64% of all SSBCI-supported lending programs. As member of this committee, we need to be doing all we can to support CDFIs and the work they're doing to support our communities, and this includes fulfilling our oversight responsibility. My amendment will enhance the underlying bill by requiring reporting on how the Treasury Department and CDFI Fund are supporting the work of CDFIs and their participation with SSBCIs. This amendment will help ensure that CDFIs and SBCI programs are investing in the communities they're supposed to be supporting and are effectively partnering with one another. Moreover, this amendment will also ensure both programs continue to be good stewards of taxpayers' money. I yield back, Mr. Chairman.
The gentlelady yields back. Is there further debate on the gentlelady's amendment?
I have move to strike the last word. I have an amendment. Well, no, I moved to strike the last word on this one. Okay.
Republican first, at the other side first. So for what purpose is the gentleman from Tennessee?
I move to strike the last word.
Gentleman's recognized.
And I simply want to say that I thank Ms. Velasquez for her thoughtful amendment, and I'm willing to accept the amendment, and I hope that she will support the underlying bill.
Indeed.
Thank you. I yield back.
Does the gentleman yield back?
Yes.
Gentleman,
I moved to strike the last word.
for what purpose does gentlelady seek
I
recognition?
moved to strike the last word.
Gentlelady is recognized for 5 minutes.
I want to thank Ms. Velasquez for this amendment. She's been a friend and a fierce champion of CDFIs as well as our nation's small businesses. During the pandemic, again, I had the pleasure of partnering with her to help secure a $60 billion set aside to allow our community financial institutions, including CDFIs and MDIs, to deploy PPP funds to small businesses across the country. Let me just tell you the reason we did that. We did that because the big banks basically created their own panels and they gave to their concierge clients all the money. They used up the PPP money, and we had to come back and get money for the minority banks and for the small businesses. That's why we got $60 billion more dollars. This was important because CDFIs and MDIs have had a long track record of supporting minority and women-owned businesses. Last Congress, I led the effort to renew the State Small Business Credit Initiative, or SSBCI, where we provided $10 billion in federal funds for Treasury to deploy through state, territory, and tribal programs to support up to $100 billion in new loans, investments, and technical assistance to support small businesses so they can grow and thrive. So this amendment would require the annual testimony Congress receives updates on how Treasury is supporting the work of CDFIs participating in SSBCIs. Another creative idea. This funding can be helpful to small businesses, but like PPP, it is critically important that Treasury ensure CDFIs are well connected to these state programs to help deploy these funds. I will note, for Representative Rose, thank you, the sponsor of this bill, that Tennessee received $117 million to support more than $1 billion in small businesses, business lending, including a program supporting small business loans made by CDFIs and MDIs that serve rural and urban parts of the state. This amendment will help you and the rest of you understand to what extent CDFIs are able to participate in this program to support small businesses in our home states. Creative ideas, the same thing we should be doing for minority banks. So you know about CDFIs. You're taking advantage of CDFIs that were created by President Clinton and supported and advanced by Democrats. I'm glad you're able to participate and you're helping your communities. Now, I want you to give the same creative and responsive ideas to do that with banks. I yield back the balance of my time.
Gentlelady yields back. Is there further debate? If not, the question now occurs on the amendment offered from the gentlewoman from New York, Ms. Velasquez. All those in favor of the amendment shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it. The ayes have it, and the amendment is adopted. Is there further debate or an amendment on the bill? For what purpose does the gentlelady from Ohio seek recognition?
Mr. Chairman, I have an amendment at the desk.
We will pause while the amendment is distributed.
you're right. Yeah.
Have all members received a copy of the amendment? The clerk will report the amendment.
Amendment to the amendment in the nature of a substitute to H.R. 3161, offered by Mrs. Beatty of Ohio.
Without objection, the amendment is considered read. The gentlewoman is recognized for her amendment.
Thank you, Mr. Chairman. As we have just heard, H.R. 3161 requires annual congressional testimony from the Secretary of Treasury regarding the operations of Community Development Financial Institution Fund during the previous year. My amendment would simply add that the Secretary must also provide testimony on steps taken by Treasury and the fund to support CDFIs, including those that are minority depository institutions, through the Financial Agent Mentor Protege Program. I have long been an advocate for CDFIs and MDIs because they provide access to capital and financial services for LMI, minority and underserved communities. CDFIs and MDIs are best positioned to serve these communities because they understand their needs, cultural practices, languages, and norms. They are particularly effective at overcoming the trust barriers to reach the underbanked. This amendment is based on my bill, H.R. 7483, the Expanding Opportunity for MDI Act, which would codify the Financial Agent Mentor Protege Program at Treasury. The program pairs up minority-owned banks with large financial institutions, providing resources, training, and technical assistance to help them serve their communities and become financial agents to Treasury. My legislation in this amendment are particularly necessary due to the significant decline in the number of MDI banks and credit unions. There are only 148 MDI banks left in the United States, and the number of minority-owned banks has dropped 32% since its peak in 2008. Although their numbers have largely stabilized in recent years, MDIs generally have much higher expenses and are often forced to merge with other minority-owned banks just to survive. My amendment would ensure that Congress is periodically updated on Treasury's effort to support these essential financial institutions, which are at the front lines of serving communities across the nation who have historically been denied access to the financial system. I urge my colleagues to support this, and I do support Mr. Rose's bill. Mr. Chairman, there may be a technical, or Madam Chairman, there's a S left off of the word institution for grammar.
We will fix that at the end.
All right, thank you. I yield back.
Gentlelady yields back. Is there any further debate? For what reason does the gentlelady from
I
California?
move to like to Strasburg. I want to thank Ms. Beatty for her amendment, which I believe is so helpful. It is a helpful addition to ensuring transparency and accountability in support provided CDFIs, particularly minority depository institutions, through Treasury's Financial Agent Mentor Protege Program. This is a program where larger financial institutions mentor smaller ones, passing along management and technical advice, as well as business connections to allow CDFIs and MDIs to expand. As I have expressed time and time again, CDFIs are the backbone underserved communities, for underserved communities who have been historically excluded by traditional financial institutions. MDIs, in particular, play a vital role in addressing the unique needs of communities of color. But despite their success in providing affordable capital to these communities, as evidenced by their work during the pandemic, the number of MDI banks and MDI credit unions have declined by about 1/3 in the decade following the 2008 financial crisis. The Financial Agent Mentor Protege Program will help to support CDFIs and MDIs and subsequently foster additional opportunities to strengthen women and minority-owned businesses. So, as you Republicans are saying, they're committed to fostering transparency. I'm sure they will have no problem in supporting this amendment and ensuring that Treasury's efforts in this regard are transparent, accountable, and effective. Let me tell you why. it is so important not only to demand in a bill that we have a hearing once a year or whatever on CDFIs, yeah. But what I am worried about is this. There is a national move by the conservative element in this country to get rid of diversity and inclusion. And it goes into every aspect of our society. So I don't want anybody saying that we should have CDFIs here so we can hear from them once a month to beat up on them. I want them to be supported. And these amendments that we're doing puts meat on the bones of that bill, not only to have them come and to be able to hear from them, but to talk about what we can do more to support them. So I'm thankful for the opportunity for both Ms. Velasquez and Ms. Beatty to put the meat on the bones, to them coming in here once a year. I don't look forward to anybody trying to dismantle them, trying to discourage them, trying to get rid of them. Let's all work because we all benefit, all of our communities. Just like I told you about Mr. Rose, there are other communities that benefit from these CDFIs. So I want support, and I yield back the balance of my time.
Gentlelady yields back. Is there any further debate? For what reason does the gentleman from Tennessee seek recognition?
I move to strike the last word.
Gentleman's recognized.
Thank you, Chair Lady, and I want to say to Ms. Beatty, I appreciate, again, the thoughtful amendment, and I'm certainly happy to support the amendment and hope that you will support the underlying bill. And I want to just assure the ranking member that the whole reason that this bill came to be, from my perspective, again, as I related in my opening remarks about it, is visiting a community and seeing the impact of what I saw as a failure of the CDFI management at the time to allow to move forward a branch institution that was going to serve a minority community that was severely underbanked. And I know we talk about that here a lot. And so it really highlighted to me, and Chairman Barr was involved here as well because he was already interested in this issue. So I thank you for the amendment, and I'm willing to support it, and yield back the balance of my time.
Gentleman yields back. Is there any further debate? Hopefully not. If not, the question now occurs on the amendment offered by the gentlewoman from Ohio, Ms. Beatty. All those in favor of the amendment shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it. The ayes have it, and the amendment is adopted.
I have an amendment.
Okay, for what purpose does the gentlewoman from California seek recognition?
I have an amendment at the desk.
We will pause while the amendment is distributed. Thank you, ma'am. I believe that all members have the amendment. The clerk will report the amendment.
Amendment to the amendment in the nature of a substitute to 3161 offered
Without
by...
objection, the amendment is considered read. The gentlewoman is recognized on her amendment.
Thank you very much, Madam Chair. First of all, I want to commend Mr. Rose's bill, a bill that centers some attention on CDFIs and bring them before us. And my amendment seeks to strengthen Representative Rose's bill by adding more specificity so we can ensure that we make the best use of committee time with this new testimony requirement by directing the Treasury to report on pressing issues faced by CDFIs as well as MDIs across the country. Specifically, my amendment would require additional reporting in the testimony to describe what steps the Treasury Department and the CDFI Fund are taking to strengthen CDFIs. This includes Treasury's work to promote and preserve MDIs, including those that are CDFIs pursuant to Section 308 of FIREA, updates on how CDFIs and MDIs that received $12 billion capital investments and grants authorized in 2020 are using these funds, ensuring CDFI certification and reporting requirements are appropriately streamlined, exploring securitization options that might help expand the reach of CDFIs, addressing technology challenges facing CDFIs and MDIs, incentivizing CDFIs to provide startup capital for young entrepreneurs, and raising public awareness about CDFIs and MDIs, such as providing a searchable map with locations of these community lenders. This amendment is largely based on my bill, H.R. 7978, the Promoting and Advancing Communities of Color through Inclusive Lending Act, which I believe passed the House twice in 2022, including as part of a bipartisan, unblock amendment to NDAA. So I urge my colleagues to continue from both sides of the aisle to support this amendment because it is exactly what we had bipartisan support on before.
The
back.
gentlelady from California yields back. Is there any further debate? Mr. Rose? Does the gentleman from Tennessee seek recognition?
I move to strike the last word.
Gentleman is recognized.
And I thank the ranking member for this amendment and am willing to accept it and I hope that she might support the underlying bill. I would just say, I mean, I'm not opposed to the specifics of the amendment, but would just point out that the bill that Ms. Pedersen and I proposed would allow all of this. We're certainly happy to accept the specificity, and so I will support the amendment. Thank you.
Gentleman yields back. Is there any further debate? If not, the question now occurs on the amendment offered by the gentlewoman from California, Ms. Waters. All those in favor of the amendment shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it, and the amendment is adopted. Okay, are there any further amendments? Wonderful. There being no further discussion on amendments to the bill, the question now occurs on adoption of the amendment in the nature of a substitute as amended, offered by the gentleman from Tennessee. All those in favor shall signify by saying aye. 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 All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it, and the amendment is adopted. The question now occurs on ordering the bill H.R. 3161 as amended, reported to the House with a favorable recommendation. Those in favor shall signify by saying aye, and those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it, H.R. 3161 as amended is ordered favorably, reported to the House. A motion to recommit is, in fact, laid on the table. We will pause one moment, please.
Pursuant to notice I call up H.R. 8337, the Bank Resilience and Regulatory Improvement Act, introduced by me. The clerk will report the bill, which was distributed in advance.
H.R. 8337, to amend the federal banking laws to improve the safety and soundness of the United States banking system and for other purposes.
Without objection, the bill is considered read and open to amendment at any point. I now have an amendment in the nature of a substitute, copies of which have been distributed in advance. The clerk will report the amendment.
Amendment in the nature of a substitute to H.R. 8337, offered by Mr. Barr of Kentucky.
Without objection, the amendment is considered read and will serve as the base text for purposes of the amendment.
I object to treating the ANS as base text.
The ANS will be treated as a first-degree amendment. I now recognize myself for 5 minutes. I urge my colleagues to support my legislation, the Bank Resilience and Regulatory Improvement Act, which will provide financial institutions with the relief needed to serve their communities and customers without the punitive regulatory and supervisory burdens that impede them from doing so currently. This is really about unleashing the American dream. This legislation does a number of different things. One, it tailors regulations for small and mid-sized banks so that they can meet the demands of their markets without being held back by onerous requirements that are not appropriately tailored. Second, it creates a shot clock for merger applications at the Fed, OCC, and FDIC to provide timely decisions. Third, provides transparency in Federal Reserve stress testing to better understand capital requirements that are developed from the results. Fourth, creates an improved process for supervisory appeals so institutions are able to obtain a fair shake with such conversations with their regulators. And fifth, requires transparency and action to improve and update discount window operations at the Federal Reserve to fit the needs of potentially fast-paced liquidity needs of solvent financial institutions. Small institutions face higher hurdles in the regulatory environment. This is why my colleagues from both sides of the aisle and I work tirelessly to include tailoring in S2155, and why we are highly concerned about the federal regulators' recent flawed proposals that repeal this tailoring and move to a damaging one-size-fits-all approach. Certain asset thresholds put forward in the Dodd-Frank Act are too low, and burdensome regulations continue to plague the mid-sized banks. To provide these institutions with the relief they need so that they can provide financial services to their markets and reduce high regulatory compliance costs, we must raise asset thresholds on certain regulations. At the very least, we must recognize that the thresholds from more than a decade ago do not properly account for price and asset value inflation that has occurred in the interim. And this is getting exactly at the point that the gentleman from Massachusetts earlier made, that these are the institutions that faced deposit outflows in 2023 after the instability in March. Another way to ensure that small, mid-sized, and regional banks can meet economies of scale and meet market demands is through mergers and acquisitions. Mergers of financial institutions can promote competition and generate cost savings that can then be passed on to consumers, and they help preserve a robust banking system. Mergers also allow, importantly, distressed banks to sell themselves instead of failing, thereby insulating the Deposit Insurance Fund from losses. This is why I call this bill the Bank Failure Prevention Act. Unfortunately, the current slate of Democrat-appointed regulatory officials would like to eradicate any chance for healthy mergers to be approved, putting the Deposit Insurance Fund at greater risk. Implementing a shot clock will improve timeliness and set clear expectations for the merger application process. Another provision of this legislation calls for transparency and clarity on stress testing, which currently involves a black box in which numbers magically appear without adequate explanation as to how they are generated. To remove opaqueness between the Federal Reserve and the institutions subject to stress testing process, a rulemaking requirement must be implemented. This will allow for proper public engagement and insight into the U.S. capital framework. This insight allows Congress to properly oversee the Federal Reserve to monitor the stress testing process and the capital framework. To continue with improving the regulatory regime, the legislation includes a provision on amending the supervisory appeals process. I often hear that institutions do not appeal their supervisory findings because they do not want to question their regulators and feel that there is not a meaningful process. Due process is the cornerstone of American freedom, and this legislation will allow and promote institutions to meaningfully exercise this right. Another area of our banking system that hinders institutions' resilience is the discount window. As Fed Chair Powell admitted, following the March 2023 banking instability, the operation of the discount window lending can be clunky. To resolve this legislation requires transparency and a plan from the Fed to identify and to remediate problems in discount window operations and to adapt those operations to better fit the sometimes fast-paced liquidity needs of distressed financial institutions. Better discount window operations could have prevented some of the bank failures that we saw in March 2023. Creating a regulatory environment that promotes transparency, accountability, and dynamism is necessary for enhancing financial stability and allowing safe and sound financial institutions to prosper. The Bank Resilience and Regulatory Improvement Act requires federal banking regulators to foster this environment so our community, mid-sized, and regional banks can comply with regulations in a meaningful way that allows them to be competitive and thrive. This legislation will reform our bank regulatory environment for the better and will especially benefit our smallest institutions. All my colleagues will agree that diversity of our banking system is what makes it the envy of the world, and this legislation protects and enhances this diversity. I urge all my colleagues to support the bill, and my time has expired. Is there further debate? The gentlelady from California strikes the last word. She is recognized for 5 minutes.
Thank you very much, Mr. Chairman. I strongly oppose H.R. 8337, which gives the wrong lessons from the regional bank failures from last year and collectively represents a dangerous rollback of critical safeguards designed to protect consumers, maintain stability in our financial system, and promote fair competition in the marketplace. This bill's deregulatory approach will undermine the safety and soundness of the banking system, similar to how Trump-era rollbacks resulted in the 2023 regional bank failures. It is important that the regulatory framework is risk-based and appropriately focused on significant risk. However, it is equally important that basic safeguards and oversight are in place so consumers are protected and bank failures do not turn into larger problems. This bill proposes too many dramatic increases in regulatory thresholds with little justification. For example, the bill would dramatically raise a number of exemption thresholds by 500% from $10 billion to $50 billion, which though 97% of all banks are already exempt from things like CFPB supervision. Moreover, instead of including provisions to ensure regulators quickly escalate under-addressed safety and soundness issues that examiners find, this bill will make it easier for large banks like Silicon Valley Bank to appeal and challenge those supervisory findings. This bill would make it harder for banking supervisors to do their job to promote safety and soundness. This is also an anti-competitive bill that will make big banks even bigger, resulting in higher prices for consumers, fewer bank branches, fewer loans for small businesses, and fewer community banks. Instead of addressing the rubber stamping problem that we've seen in recent years with nearly all bank merger applications being approved, this bill will accelerate that trend. Reducing the scrutiny of mergers will increase the cost and reduce the availability of services that consumers need. In places across the country, we've watched bank mergers lead to branch closures, making it even harder, particularly for low-income consumers, to access banking services. One study examining bank deserts that were created as a result of industry consolidation between 2008 2016 showed these deserts disproportionately impacted people of color, with 25% of rural branch closures occurring in majority-minority census tracts. Furthermore, the largest credit card companies charge consumers higher interest rates compared to smaller credit card companies, resulting in many consumers paying 40 to 50% more every year in additional financing costs for effectively the same service. small bank businesses suffer too. For instance, fewer banks mean lending declines, and for those who are able to secure credit, it becomes more expensive and the average loan size shrinks. While there are a couple of small provisions we could work together on, like on discount window improvements and GAO reviews of stress testing, the vast majority of the bill is a lot of rollbacks that must be rejected. So I urge my colleagues to reject this bill and instead focus on policies that promote safety and soundness, fair competition, and ensure the stability of our financial system. I yield back.
Gentlelady yields back. For what purpose does the gentleman from Tennessee seek recognition?
I move to strike the last word.
Gentleman is recognized.
I want to begin by saying that broadly, I support Chairman Barr's bill and think that it is moving us in the right direction. And I feel confident as I think about the steps taken here that this is going to actually strengthen our banking community and allow banks to avoid, frankly, in many cases, the crush of unnecessary regulation, particularly for our small community banks that are not the source of current problems, recent problems in the banking industry. So I commend the chairman for this fine piece of legislation. There have been some concerns that have been raised by interested stakeholders about one provision in particular in the legislation, and I wonder if I could engage the chairman in a colloquy on that.
I thank my friend and colleague from Tennessee, Mr. Rose, for engaging me in the colloquy.
Mr. Barr, I wonder if you would be willing to work with members on stakeholder concerns before the bill comes to the House floor.
I thank you for raising some of these stakeholder concerns, which I've just recently heard of this morning, and I commit to working with any of my colleagues, including you, Mr. Rose, on any of these concerns before the bill moves to the floor.
Well, I appreciate that very much, Mr. Chairman, and I want to say with that understanding, I can support the bill, and I appreciate again your offering this helpful piece of legislation. I yield back.
Thank you.
I have an amendment to this.
Gentleman yields. Is there further debate? The gentleman, for what purpose does the gentleman from Wisconsin seek recognition?
Move strike the last word.
Gentleman is recognized for 5 minutes.
Well, I wanted to thank you, Chairman, for working together on the Bank Merger Prevention Act, which is included in this package that we're discussing. The consequences of merger delays can significantly harm both the acquiring institution and the target, causing greater operational risk. Increased expenses, reputational risk, and staff attrition is always a concern in the face of a prolonged and drawn-out, unnecessarily merger operation. This is not just a problem for the biggest banks. Uncertainty in the merger process limits opportunities for succession planning, especially in smaller or rural communities, and could lead to what is referred to as quote-unquote zombie banks that continue to exist but have no competitive viability or exit strategy. A lot of times we're hearing that regulators seem to take for granted that bank merger applicants need to continue to operate with an eye towards the future when a merger is underway. But just yesterday I spoke with a bank that was involved in a merger, and they cannot simply hit the pause button during the merger review process. Unfortunately, our financial regulators have put forth some proposals that would compound these problems rather than make the process even more transparent and predictable. This bill would establish clear expectations and timelines surrounding the review process, which is critical for many of these banks. And they can also make informed decisions as to whether to continue devoting resources and incurring costs when approval is likely or withdrawal of an application could reduce overall expenses. So I think it's long overdue. I think it's something we need. I know that there were a few things that the ranking member had brought up, and I would just say that, the question of too many bank mergers being approved, bank mergers require significant upfront and ongoing investment, as we know, in a number of resources that otherwise, a bank would not have to expenditure during that period of time. And so this includes finding a target, conducting due diligence, and negotiating the terms of the transactions. The mergers also increase competition and make the banking system more dynamic versus downsizing it. So allowing banking organizations to realize kind of the economies of scale, the scope via mergers and acquisitions creates competition and generates cost savings that can be passed on to consumers. So ultimately, I think when you've got a bank that's struggling, the merger might be the only way out. The bill would require the Federal Reserve Board to grant and deny a bank merger or acquisition application within the 90 days. The shot clock, as Mr. Chairman, you've described it numerous times, regardless of whether the record on such initial application was complete or not. So once again, I would urge members to support the bill. I think it makes sense, and it's something that banks think would put them in a much better position. I yield back.
Gentleman yields back. For what purpose does the gentlelady from
I have an
California?
amendment at the desk.
The gentlelady has an amendment at the desk. We will pause while the amendment is being distributed.
I don't remember what he was in judiciary. He did judiciary. Wasn't he a judge? That was 20 years.
Have all members received the amendment? The clerk will report the amendment.
Substitute amendment to the amendment in the nature of a substitute to H.R. 8337, offered by Ms. Waters of California.
Without objection, the amendment is considered read. The gentlewoman is recognized for her amendment. The ranking member is recognized for her amendment.
Mr. Chair, I'm proud to offer this substitute amendment along with Representatives Sherman, Green, Lynch, Costin, Talib, and Pedersen. This amendment includes thoughtful legislation each of my colleagues introduced, along with me, in the aftermath of the regional bank failures last year. For example, one provision would expand regulatory authority with respect to clawing back compensation, imposing fines, and banning future work in the industry for any bank executive that ignores supervisory warnings, cashes out multi-million-dollar bonus checks while they drive their bank into the ditch. This provision has broad bipartisan support in the Senate. Another bipartisan provision would ensure that large banks like J.P. Morgan Chase do not grow bigger through buying a failed bank like First Republic Bank when the FDIC and other bidders are ready to buy the bank as well. This has other executive accountability provisions, including ensuring a large bank like SVB is penalized if it is missing its chief risk officer for 9 months. We would also shield community banks from paying for the sins of large banks that recklessly fail. Our amendment also includes 2 bills we recently passed to ensure there's strong oversight of any future major bank failure and that banks like SVB have to maintain capital for their securities portfolio when it has large unrealized losses. Moreover, this amendment would require regulators to establish a supervisory escalation strategic plan to ensure they move more quickly, escalate problems that go unaddressed, and use more potent tools like imposing an asset cap, as Janet Yellen did with Wells Fargo when she was at the Fed. This amendment would require bank regulators to hold public hearings on large bank mergers like Capital One and Discover. And finally, while the Fed works on improving the discount window, this amendment would extend the CARES Act provisions to ensure thousands of small credit unions also have access to emergency liquidity through NCUA's Central Liquidity Fund. These are all sensible measures, and for all members that care about promoting safety and soundness, financial stability, competition, transparency, and accountability. I then urge your support for the amendment. I yield back.
The gentlelady yields back. Is there further debate? I recognize myself for 5 minutes in opposition to the amendment. I appreciate the ranking member's the spirit with which she is introducing the amendment, because her stated goal is to enhance the safety and soundness of our banking system. Unfortunately, I think many of these provisions would actually do the exact opposite. But more to the broader point is that this amendment addresses issues that are different than those covered in my bill. Many of the provisions relate, for example, to executive compensation, which is well outside the topics covered in my bill. I do think some of those provisions would have the potential, and maybe more than just the potential, but to diminish the incentives for talented financial services professionals to enter or remain in leadership positions in banking, which is precisely the wrong outcome and maybe an unintended consequence of the gentlelady's amendment. You don't want folks who don't know what they're doing in leadership positions. If you want a safe and sound banking system, you want the best and the brightest to stay and remain in leadership positions in these especially complex and large institutions. The provisions in here that would actually diminish the opportunity for healthy mergers, I think the gentleman from Wisconsin made some very good arguments for why healthy mergers actually enhance safety and soundness and promote financial stability, prevent bank failures that actually would jeopardize the system. Many mergers actually present greater competition to the large too-big-to-fail banks. I don't think we would want to enact the gentlelady's amendment and actually diminish the opportunity to create larger, more sophisticated firms that can provide that competition to Wall Street firms. I hearken back to a hearing that when the ranking member was chair, she called the CEOs of all the large banks in the country, and included in that hearing the CEOs of some of the super regionals, which was a very fascinating hearing because it gave me the opportunity to ask one of the CEOs of the largest banks in the country, who was sitting next to one of the CEOs of a newly merged super regional bank, the following question. I said to the CEO of Bank of America, which of the three institutions present a more formidable competitor to Bank of America? Is it SunTrust acting alone? Is it BB&T acting alone? Or is it Truist? The combination of those two. And he said, undoubtedly, it was Truist. It was the result of a merger that created more competition for a big Wall Street, too-big-to-fail institution. And I fear that the Waters Amendment here would actually further erode the possibility of some of those healthy mergers and prevent some of those mergers that would actually prevent losses to the Deposit Insurance Fund. I'm happy to continue working with the ranking member and other colleagues on the issues raised in this amendment. However, I urge my colleagues to vote against the amendment, not only because it runs completely counter to the whole idea of the underlying legislation, which is to provide for regulatory tailoring and enhance competition within the banking system, enhance diversity, but I do believe that some unintended consequences would
Would the
follow.
gentleman merge?
Would follow, and those unintended consequences would actually undermine financial stability.
Oh, my goodness.
Actually undermine financial stability. With that, I yield back. Is there further debate on the gentlelady's amendment? If not, the question now occurs on the amendment offered by the gentlewoman from California, Ranking Member Waters. All those in favor of the amendment shall signify by saying aye.
Aye.
All those opposed shall signify by saying nay. Nay. In the opinion of the chair, the nays have it.
Request a recorded vote.
A recorded vote is requested. All those in favor of a recorded vote, raise your hand. A sufficient number having raised their hand, a recorded vote is ordered pursuant to subsection C5 of Rule 3 of the committee rules. Further proceedings on the amendment are postponed. For what purpose does the gentleman from Illinois, Mr. Foster, seek recognition?
I have an amendment at the desk.
We will pause while the amendment is distributed. Have all members received a copy of the amendment? The clerk will now report the amendment.
Amendment to the amendment in the nature of a substitute to H.R. 8337, offered by Mr. Foster of Illinois.
Without objection, the amendment is considered read. The gentleman is recognized for his amendment.
Thank you, Mr. Chairman. As many of you know, I'm a big fan of getting half a loaf, making bipartisan progress where we can, and returning in the future to make further progress. And while I cannot support the entirety of the underlying bill, the legislation does contain elements on a few important issues that I believe we would receive broad support among Democratic members of this committee, and also increase the chances that this bill would be passed by the Senate and signed into law by the President. My amendment would strike most of the most partisan provisions of this legislation, but leave intact in its entirety Title V and modify Section 4, thereby narrowing the scope of the bill to areas where I believe bipartisan agreement can be found. Specifically, my amendment retains provisions requiring regular GAO reviews of the effectiveness of stress testing, and Title IV, which would require regulators to review operations of the discount window and develop a strategic plan to make improvements, with modifications I believe are in line with the intent of my Republican colleagues. Stress testing is an important part of our supervisory framework, and I agree that it's appropriate to have regular outside reviews of the process to ensure that the tests are sufficiently promoting the preparedness for stress events and underlying salient risks that could affect the safety and soundness of the banking system. Regular GAO reviews would alert members of this committee of any shortfalls of stress testing, provide some warning signals for regulatory capture, which is always a worry in any regulatory proceeding, and allow regulators and Congress to make improvements as necessary. The underlying bill also aims to address important issues related to the functionality and accessibility of the discount window. In fact, our federal banking regulators seem interested in this topic as well and may be making progress independently of this committee, but certainly it would not hurt if we reinforce their efforts. They are currently working on a liquidity proposal that may address some of the things addressed in Title V, but having the regulators look at this and provide information to the committee would be very helpful. So I appreciate the approach taken there. And while I support those provisions, I cannot support the underlying bill. Other titles of the bill limit regulators' access to information in the merger review process, expand the appeals process in a way that will make it harder for regulators to address weaknesses within the banks they supervise, and failing to address the concerns of bank supervisors can have a disastrous effect on the banking system. Just looking at Silicon Valley Bank, regulators knew the bank had issues that needed to be addressed, and while regulators should have been more aggressive in their response to the issues at SVB, it's an example of how a delayed response to a supervisory finding can lead to serious consequences. Again, I appreciate the efforts here and to try to support a diverse banking system, but I don't believe that the bill in its entirety is the correct approach, and I encourage my colleagues to support my amendment that would focus on the parts of this legislation where we can all agree. Thank you. I yield back.
Gentleman yields back. I recognize myself for 5 minutes in reluctant opposition to the amendment. I appreciate the gentleman's amendment and his good ideas. And let me just say, number one, I appreciate the fact that the gentleman from Illinois recognizes that there are some points of common viewpoint and agreement, and that he recognizes that there are some good ideas contained in our bill. So we've got a basis to work together on forging some bipartisan agreement here going forward as this legislation hopefully moves to the House floor. Let me also commend the gentleman for including some good ideas in his amendment that I think we could adopt, agree to, accede to. There are, however, and I agree that the discount window and stress testing are important issues, and we need to refine, we can refine this legislation to make sure that we forge agreement on it. The one area that I have to object to in the amendment, though, is that the amendment, as I understand it, would eliminate the dedicated testimony in a separate hearing by the chair of the Fed on fixing the discount window. And it is the position of the majority, of myself as the author of the bill, that fixing the discount window is so important from a standpoint of looking at the new speed in which deposit outflows can occur, liquidity issues that we saw in March of 2023. This is one of the crux of the issues in terms of, and I know the gentleman has talked a lot about this, and this is an area where we agree on addressing liquidity challenges in a new world in which electronic banking makes the danger of runs more severe. So fixing the discount window, I think, is a really important part of the solution, and that's why I would submit it deserves a hearing on its own, a dedicated set of testimony by the chair of the Fed that really hones in and focuses on this liquidity issue and fixing the discount or destigmatizing the discount window. I commit to working with you on the issues you raised, but for that reason, I urge my colleagues to vote against the amendment. With that, I yield. Vote against the amendment. Is there further debate on the amendment?
Can I move to strike?
For what purpose does the gentlelady from California seek recognition?
I move to strike the last
The
word.
gentlelady is recognized.
Which number is this? Number 4? 1 moment, please. Did I put it in here? Maybe it's up on here. Thank you. Thank you. I move to strike the last word.
Gentlelady is recognized.
I support this amendment from Representative Foster, our ranking member for the Subcommittee on Financial Institutions and Monetary Policy. As we have discussed, most of the underlying bill is an unacceptable form of deregulation that will undermine safety and soundness and competition in the marketplace for the benefit of our consumers. However, there are two small provisions tucked into the bill where we could find some common ground. One is having GAO periodically take a look at the stress testing regime and see if it is being well implemented or if there are things that need to be improved, like checking interest rate risk or when the Fed is quickly raising interest rates. The other is on improving the functioning of the Fed's discount window and to have some congressional oversight of that effort. Given that we have real-time payments, we need real-time emergency liquidity that is tested and functions well to help mitigate contagion in any future crisis. Representative Foster is giving members an opportunity to choose bipartisanship with this amendment. I see no reason why we shouldn't move forward with these provisions in a bipartisan manner. I urge members to support the amendment, and I yield back. I yield to Mr. Foster.
Yeah, I was just wondering if the chair might consider unbundling the five titles of this into two different packages, one containing the two amendments, so we have a pretty strong basis for moving forward.
Yeah, I appreciate the gentleman yield. I appreciate the gentleman's question. I think we're past that point. I think that the bills have been put into a package. I would be interested in working with you. You know, it is problematic on our side that the amendment strikes the bulk of the legislation. So, but
Yeah, and I'm not suggesting that we don't have an independent vote on that. Just if we had an unbundled vote, there's one that could get, I think, a lot of Democrats.
Well, I'll work with and of course, working with the chairman and the ranking member on proceeding to the floor and how we as a committee would approach the Rules Committee in bringing this package to the floor. And I think there is opportunity procedurally to maybe do some of those things and where we can find common ground on amendments, find some amendments to work together on in the Rules Committee.
I appreciate that.
Appreciate that. The gentleman yields back to the ranking member.
Thank you very much. I yield back.
Gentlelady yields back. Is there further debate? If not, the question now occurs on the amendment offered by the gentleman from Illinois, Mr. Foster. All those in favor of the amendment shall signify by saying aye. All those opposed shall signify by saying nay.
Nay.
In the opinion of the chair, the nays have it. The nays have it, and the amendment is not adopted. There being no further amendments without objection, the previous question is ordered and recorded votes on the pending amendments have been proposed. Once those votes are taken, the committee will immediately consider the question to report the measure. Pursuant to notice, I call up H.R. 8338, the Clarity in Lending Act, introduced by the gentlewoman from California, Ms. Kim. The clerk will report the bill, which was distributed in advance.
H.R. 8338, to regulate small dollar, short-term credit products to protect the privacy of lenders and to improve the unfair, deceptive, or abusive acts or practices authority of the Bureau of Consumer Financial Protection and for other purposes. Be it enacted by the Senate and House of Representatives of the United States of America in Congress assembled. Section 1, short title, Table of Contents. This act may be cited as Clarity in Lending Act. Table of Contents. The table of contents for the act is as follows.
Without objection, the bill is considered read and open to an amendment at any point. The gentlewoman from California has an amendment in the nature of substitute, copies which have been distributed in advance. The clerk will report the amendment.
Amendment in the nature of a substitute to H.R. 8338, offered by Mr.
Without objection, the amendment is considered read and will serve as base text for purpose of the amendment.
I object to treat the ANS as base text.
The ANS will be treated as a first-degree amendment. The gentlewoman from California is recognized for 5 minutes.
Thank you, Chairman. And I would like to thank the committee staff for working with us to get these bills marked up. H.R. 8338, the Clarity in Lending Act, is a package that includes 4 bills. My bill, H.R. 3856, the Small Dollar Loan Certainty Act, and the FI Chairman Barr's H.R. 6789, Vice Chair Hill's H.R. 1806, and National Security Chairman Luckmeyer's H.R. 1810. I thank each of my colleagues for their leadership on these bills. Together, these bills aim to provide certainty to the credit market for small businesses and families. My bill, H.R. 8338, follows interagency guidance for responsible small dollar loans issued back in May 2020. In the guidance, financial regulators recognize the role small dollar loans can play in helping borrowers meet their needs due to an emergency. The goal of H.R. 8338 is to codify the joint guidance issued back in 2020 to ensure a more predictable small dollar lending policy that is not subject to the political whims of the day or regulatory uncertainty. We know that millions of Americans are in financial and economic distress. Last year, a 2023 Federal Reserve report on economic well-being of U.S. households found that fewer than 2 in 3 Americans could cover a $400 emergency with cash. So, H.R. 8338 aims to expand credit for those individuals, sole proprietors for small businesses, and families while protecting their consumer rights. For instance, in order for a small dollar credit product to qualify for the safe harbor, the repayment term has to be more than 45 days. Rollovers into new small dollar credit products are prohibited, and financial institutions may not issue a product if the consumer has an existing one with another financial institution. Additionally, if the financial institution decides to provide a small dollar credit product under the safe harbor, the product must not have a balloon payments. It also prohibits penalties and overdraft or non-sufficient funds fees in connection with the product. Finally, an important component of the guardrails under this safe harbor limits the amount of the loan to $3,500 or less. I would also like to emphasize that the safe harbor does nothing to prevent financial regulators from issuing an injunction or a court order if a financial institution is found to be violating consumer protections. Additionally, the financial regulator can demand restitution from the financial institution to the consumer if there is economic wrongdoing. H.R. 8338 also aims to help consumers who may be underbanked or credit invisible to build their credit. The CFPB estimates that roughly 26 million Americans are credit invisible. That's about 11% of the adult population. So, we have to think about creative ways to incentivize the credit market to deploy financial products that can help the millions of credit invisibles and afford them the opportunity to be seen and to be empowered. I also want to make clear that nothing in H.R. 8338 may be interpreted to prohibit a covered entity under the bill from offering a small dollar product that does not comply with the safe harbor. Other small dollar consumer loan products by state-regulated finance companies and non-bank institutions have an important role to play in the credit market and are often complementary to those offered by depository institutions. As an immigrant and small business owner myself, I know how difficult it is to get access to capital and credit. My community often had to raise funds from our neighbors and friends because as an immigrant, we had no way of showing a credit history and the ability to repay a loan. With H.R. 8338, we do right by those immigrant and underrepresented communities who may have a little to no access to credit. So I urge my colleagues to support the overall package to provide regulatory certainty and enhance options for consumers. I yield back the balance of my time, Chairman. Thank you.
The gentlelady yields back. Is there any further debate?
I move to strike the last word.
Gentlelady from California is recognized for 5 minutes.
Thank you. I oppose H.R. 8338, which is a package of several bills that would undermine the CFPB, give banks broad exemptions from various requirements, and ultimately harm consumers and small businesses. Let's start with small businesses. This bill would grant exemptions from the CFPB's requirement for lenders to report small business lending data. This would reduce transparency in the small business lending market and make it harder to detect concerning trends like discrimination. This will undoubtedly prevent agencies from effectively responding to small business lending needs. I can't believe that those on the opposite side of the aisle, led by Ms. Kim on this one, who claim to support small businesses, who claim we want to do more to ensure access to capital, who claim we want to do more to ensure that all communities are being served by all of the banks in this country. And we know that the banks do not give loans to small businesses, and the option that we have created with CDFIs is taking up the slack because small businesses are discriminated against. I cannot believe this bill that says that you would make it harder to detect concerning trends like discrimination. This will undoubtedly, again, prevent agencies from effectively responding to small business lending concerns. You don't need the information. You don't need to know who's not supporting small businesses. You don't need to have any reports on that. That's outrageous. It is interesting that Republicans are marking up another bill that is purportedly trying to bring transparency to the CDFI fund, but when it comes to small business lending, they prefer a lack of transparency. Now let's talk about consumers. This bill would narrow the scope of a key consumer protection provision in Dodd-Frank that prohibits unfair, deceptive, or abusive acts of practices known as UDAP. It would also hinder the CFPB's enforcement powers, making it harder for our consumer watchdog to go after bad actors. I have to tell you that I was on the conference committee of Dodd-Frank reforms, where we worked so hard to deal with discrimination and lack of support for small businesses, to give consumers an opportunity to have some place to take their complaints, like the CFPB. I am absolutely surprised that this bill would undermine all of that work. It would hinder the CFPB's enforcement powers. Again, making it harder for our consumer watchdog to go after these bad actors. Further, this bill creates loopholes that bad actors will inevitably exploit, leaving consumers vulnerable to predatory lending practices and discriminatory treatment. This bill also is chock full of giveaways to industry. This bill gives banks, credit unions, and any of their lending partners, including payday lenders, immunity from civil penalties for violating a wide range of consumer protection laws, including the Truth in Lending Act, the Fair Credit Reporting Act, the Equal Credit Opportunity Act, and the Fair Debt Collection Practices Act, among others. Finally, this bill would undermine the CFPB by adding unnecessary delays and hurdles to enforcement actions, further impeding the CFPB's ability to respond swiftly and effectively to harmful practices, and by requiring cumbersome rulemaking procedures when the removal of sensitive small business lending data should be done expeditiously. Under this bill, the CFPB would also be prohibited from defining discriminatory practice as a UDAP violation, despite discrimination being inherently unfair and harmful. Overall, this bill package sacrifices consumer protections in favor of industry interests, creating a regulatory environment that prioritizes profits over people. You know, I was warned that despite what happened in the Supreme Court today, where Consumer Protection Agency was given the opportunity to continue to get its appropriations in ways that they could not be denied, that you were going to come back. That you were going to come back at the CFPB.
Gentlelady's time is
You were going to try to
expired.
destroy the CFPB. Okay, I yield back.
The
Madam Chair.
gentlelady yields back. The
Madam
chair now recognizes the gentleman from Texas, Mr. Williams.
Thank you,
for
Madam Chair. I move to strike the last word.
5 minutes. Your gentleman is recognized.
This package is a step in the right direction to protecting small businesses in Main Street America. The Biden administration continues to push regulations that would limit access to capital for business owners, increase compliance costs, and force small businesses to spend more time wading through red tape rather than growing their operations and meeting the needs of their consumers. I want to thank Congresswoman Kim for leading the efforts on this bill, which would allow consumers to have access to a wide variety of small dollar credit products, giving them the financial security and stability that they need. These small dollar installment loans are a reliable form of credit for business owners who are trying to make a payroll, providing them opportunity to maintain their business and support their communities. Congressman's Barr legislation included in this package stops the CFPB from their typical regulatory overreach and clarifies the standards for unfair, deceptive, or abusive acts or practices in enforcement. The CFPB has made a habit of exerting its power beyond the guardrails that Congress has intended for them, and we must rein in their constant abuse of authority. Congressman Hill and Lukumeyer's bills achieve the goal of pushing back the CFPB's egregious collection and reporting of personal information of small business loan applicants and protect small business owners from burdensome reporting requirements. Small business owners are facing new challenges every single day, like labor shortage and increased costs. The last thing they need is more government intervention in their businesses. Again, I want to thank Congresswoman Kim, as well as Congressman Hill, Lukumeyer, and Barr for their leadership on this very important package, and I urge all of my colleagues to vote in support of H.R. 8338 to push back against the Biden administration's harmful regulatory agenda. I yield back, Madam Chair.
Gentleman from Texas yields back. Does anyone else seek further debate? Gentleman from Nebraska, Mr. Flood, is recognized to strike the last word for 5 minutes.
Thank you, Madam Chairman. I'd like to voice my strong support for the amendment in the nature of a substitute to H.R. 8338 and extend my thanks to both Subcommittee Chair Barr and Congresswoman Kim for working with me to include language clarifying that the CFPB cannot allege a UDAP for acts or practices undertaken by government contractors pursuant to a government contract. This bill is particularly pressing with today's news from the Supreme Court regarding the CFPB. Without accountability regarding the CFPB's funding, we need to place other guardrails around the Bureau's authority in order to bring their extensive powers to heel. In an effort to undermine student loan repayment, the CFPB has complained that federal student loan servicers have treated borrowers unfairly or abusively when performing, and I stress this, as directed by President Biden's Department of Education. Yes, you heard that correctly. On one hand of the Biden administration, they have decided to pay less for stellar service levels, while on the other hand, the administration threatens enforcement against private parties for performing in line with the expectations of their federal contract. In recent months, Director Chopra, when speaking to student loan servicers, has stated repeatedly that, quote, budget cuts are no excuse to break the law, end quote. So this bill makes clear that contractors performing pursuant to the direction of the federal government are not violating the Consumer Financial Protection Act. Whether it be student loan servicing or another government function, the old adage of you get what you pay for comes to mind. We need to invest in a robust and effective student loan repayment infrastructure to maximize returns to the Treasury and beat back attempts to cripple the program in pursuit of illegal loan forgiveness. Government is truly dysfunctional when one agency sues another agency's contractor for performing the duties it has been hired to carry out. Again, I'd like to thank both Mr. Barr and Ms. Kim for working with me to address this issue, and I urge my colleagues to vote yes on this bill, and I yield back.
Gentleman from Nebraska yields back. Is there any further debate? Gentleman from Arkansas, Mr. Hill, is recognized to strike the last word for 5 minutes.
Madam Chair, I do, in fact, strike the last word. I appreciate the opportunity to work with Congresswoman Kim on this important measure and appreciate the hard work of the staff to make sure that we craft and pass critical legislation to provide regulatory relief both to our lending institutions and the small businesses that they serve. I'm here today in full support
of Young Kim's efforts and my portion of this bill, the Small Lender Act. And I want to thank Chairman McHenry as well for including it in H.R. 8338. As you all know, a lot's happened since last March when Congressman Luetkemeyer, Williams, and I first introduced our package of 3 bills in response to the CFPB's misguided small business data collection rule called 1071. Since then, the courts have implemented a nationwide injunction on this rule, and it's been in effect now for over 250 days. The CFPB should adhere to the courts by extending the compliance deadline for 1071 equal to the number of days that's been paused by the court. And that's why I led a letter to Director Chopra with 17 of my Republican colleagues telling him to do just that. And Madam Chair, I'd ask that it be inserted in the record.
Without objection.
Furthermore, President Biden also vetoed recently a bipartisan Congressional Review Act that would have rescinded this rule entirely. Ever since the Biden administration vetoed the CRA resolution, the Small Lender Act is a last resort because community banks need clarity and relief now to prevent the worst part of this rule from moving forward. Specifically, my legislation would do this by expanding the definition of a small lender as one that originates at least 500 small business loans a year instead of the 25 loan per year limit imposed by the CFPB. It would also codify that a small business is one with gross annual revenues of $1 million or less rather than the $5 million threshold that had been proposed. Finally, this bill extends the effective compliance date with the final rule to 3 years plus a 2-year grace period instead of the 18 months proposed by the Bureau. I want to thank the American Bankers Association, the Independent Community Bankers of America, America's Community Banks for their steadfast support of this legislation, and particularly thank my friends Blaine Luetkemeyer and Roger Williams for introducing this bill with me and their unwavering support. I want to thank Mrs. Kim and Mr. Barr for their support today to bring this to a markup. And I'm glad to see that Representative Luetkemeier's Bank Loan Privacy Act is included in the Clarity Act as well. His legislation will provide further protection for small business owners who, like many of us, are concerned by the CFPB's overreach. Madam Chair, I have 2 letters of support I'd like to insert in the record, one from the Independent Community Bankers and one from America's Credit Unions.
Without objection.
Thank you very much, and with that, I yield to Mrs. Kim if she'd like to use my remaining 2 minutes. Congresswoman? Very good, I yield back to the chair.
The gentleman's time has expired. Does anyone else seek further debate? Gentleman from Kentucky, Mr. Barr, is recognized for 5 minutes to strike the last word.
Thank you. Thank you, Madam Chair. Today I express my strong support for the Clarity in Lending Act introduced by my friend from California, Representative Kim. This important piece of legislation includes my bill, the Rectifying UDAP Act, among many other important reforms, including Mr. Hill and Mr. Luetkemeier's important reforms of 1071. These reforms are all the more important in light of the Supreme Court's decision, which I believe is regrettable, but nevertheless gives even more urgency to reforms that are included in Representative Kim's legislation before us here today. My bill brings much needed clarity to the CFPB's unfair, deceptive, or abusive acts and practices, or UDAP authority, reducing uncertainty for consumers and financial service providers. Specifically, the Rectifying UDAP Act, the provisions clarifying UDAP in Representative Kim's bill, would ensure that the CFPB cannot retroactively seek a civil monetary penalty for a practice that was not previously identified as a material finding or supervisory concern. Shocking that that would be needed, but in fact, we see many retroactive efforts by the CFPB under this director to seek penalties for practices that no one really understood were a concern before. Also, the bill would require the CFPB to conduct a rulemaking to clearly define abusive act or practice, again, providing some due process, some advance notice of what is permissible and what is impermissible. avoids conflating the concepts of abusive, unfair, and deceptive with one another, so stopping this dual pleading, provides institutions that self-identify and report UDAP violations with an opportunity to cure. Isn't that what we want? Shouldn't we want to reward good behavior? The bill also provides institutions, the bill also clarifies that discrimination, which is already prohibited by numerous laws, is not shoehorned into UDAP. It confirms that complying with government contracts for student loan servicing may not be considered unfair, deceptive, or abusive acts or practices, thanks to the leadership of Mr. Flood. Allows the CFPB to seek monetary penalties only when there has been a lack of good faith effort to comply with the law, while not impeding the ability to seek restitution for consumers who are not harmed. So a good faith compliance defense. And it also finally focuses on citing or challenging conduct as abusive in supervision and enforcement matters only when it is intentional or misrepresentative to consumers. The problem we're trying to fix is a rogue director of the Bureau, which now is fully exempt from the Appropriations Clause and not subject to meaningful oversight by the legislative branch through the power of the purse. It just makes sure that a director can't call a financial service or product abusive just because he thinks it is, without any advance notice to the financial service provider. It's kind of like the old Supreme Court definition of obscenity, I know it when I see it. That is not due process in the context of an abusive act or practice. And regulatory uncertainty, as we all know, leads to higher prices and fewer choices for consumers. And the agency tasked with protecting consumers should not be complicit in regulation that unnecessarily increases uncertainty. Unfortunately, under the reign of current CFPB Director Chopra, uncertainty has become the norm. Director Chopra instills fear and chaos in institutions through regulation by arbitrary enforcement, press releases, and blog posts or guidance, instead of through the proper rulemaking process required by the Administrative Procedures Act. Oftentimes, institutions choose to limit or cease providing certain financial products and services to consumers because of an inability to know whether the CFPB will charge them with some undefined abusive prong under UDAP, retroactively hit them with the UDAP violation, or otherwise use UDAP in an unfair, arbitrary, and capricious manner. This is not good for American consumers, and it is especially harmful for low and moderate income consumers who will be the first to lose access to the market. Robust consumer protections are vital. Access to financial services is paramount, but to ensure both, we must provide clarity, certainty, and guardrails to financial services providers. Banning in-demand financial services and products under UDAP is not consumer protection. Competition and choice is consumer protection. To achieve this clarity, I urge my colleagues to support this title and Representative Kim's package, and I yield back.
Gentlemen's time has expired. Is there any further debate? Amendments? For what purpose does the gentlewoman from Texas, Ms. Garcia, seek recognition?
Madam Chair, I have an amendment at the desk.
We will pause while the amendment is distributed. Have all members received the amendment? Clerk will report the amendment.
Amendment to the amendment in the nature of a substitute to H.R. 8338, offered by Ms. Garcia.
Without objection, the amendment is considered read. The gentlewoman from Texas is now recognized on her amendment.
Thank you, Madam Chair, and this is really a very simple amendment. It doesn't disturb any of the substance of the bill itself. It simply adds a new section 208 that seeks to protect women consumers seeking reproductive health care. Madam Chair, as you know, under Republican leadership, women's rights have been under attack and almost totally dismantled. In a post-Roe v. Wade era, women and pregnant people across the nation are facing discriminatory practices when they're seeking reproductive care. That is why my amendment would ensure that nothing in Title II of this bill would prevent the CFPB from enforcing unfair, deceptive, or abusive acts or practices for people seeking reproductive health care. Since the Supreme Court reached the Dobbs decision, many states have responded by banning the provision of abortion care, my own state included. New and impending restrictions to reproductive care have deepened already profound inequities in access to this very important services. Black, Latino, Indigenous people, people living with low incomes, members of the LGBTQ+ community, immigrants, adolescents, people living with disabilities. Madam Chair, this is not even an exhaustive list of the people likely to encounter compounding obstacles when seeking reproductive health care. There are already drivers of inequity, including income and health insurance disparities. In addition, when it comes to reproductive health care, the constantly changing landscape within and between states makes it even more difficult to protect the American people who need this very critical care. Healthcare access itself already faces discriminatory bias. Patients come in detailing stories of provider bias, including histories of belittling painful experiences for women or racist attempts to limit childbearing when seeking services of in vitro fertilization. Let me be clear. These patients are consumers. These patients are consumers just like any other consumer. It is the CFPB's duty to protect consumers. This amendment only reinforces the idea that the CFPB should have the autonomy to execute its job effectively and promptly. My amendment would prevent the use of unfair, deceptive, or abusive acts from further discriminating on an already very vulnerable population. It is needed to ensure that the CFPB can protect consumers in the rapidly evolving sectors of abortion access and in vitro fertilization services. I urge all members to support my amendment. I yield back.
Is there any further debate on the amendment?
I move to strike the last word.
Can I go to Mrs. Kim first? Go to Mrs. Kim first.
Okay.
Chair now recognizes the gentlelady from California, Ms. Kim, on the amendment.
Thank you, Chairwoman. I want to also thank the gentlewoman for your amendment, but I want to state that there is nothing in this bill that limits the topic that your amendment covers. So on that basis, I do not support the amendment, and I urge my colleagues to do the same, to vote no on this amendment.
Gentlelady yields back. Is there any further debate? Chair now recognizes the gentlelady from California on the amendment.
I move to strike the last word. Thank you very much, Madam Chair. I support this amendment from Ms. Garcia, which ensures that all consumers have equal access to financial services and are not discriminated against based on their reproductive choices. I am an original co-sponsor of the Women's Health Protection Act, which passed the House last Congress. The bill safeguards abortion access from dozens of state-level bans and restrictions and creates a national legal right for healthcare providers to provide abortions. It also creates a corresponding right for their patients to receive productive health care that is free from restrictions. Bodily autonomy is a human right, first and foremost, and one that is deeply connected to economic progress and financial anatomy. We must stop the attack on women, trans men, and non-binary persons everywhere. This amendment will prevent H.R. 8338 from causing more harm to individuals' economic stability and ability to provide for their families. Deciding to carry a pregnancy to full term is a deeply personal decision and should be a choice that every individual has. To put it plainly, reproductive justice is an economic justice. You know, members, it just goes to show you how far-reaching Ms. Kim's bill can be. And I'm thankful to Ms. Garcia for once again thinking about women and what we do to protect productive rights. You know, the members on the opposite side of the aisle must have anticipated the decision from the Supreme Court even before it was announced, because I was warned, Ms. Waters, look out. If the Supreme Court supports the Consumer Financial Protection Bureau, the opposite side of the aisle is going to come up with all kind of legislation to undermine the Consumer Financial Protection Bureau. They will never leave us alone. They hate us. They don't believe in consumer protection. And so I'm a little bit surprised that what I was warned about certainly deems to be true. Here we have this comprehensive piece of a legislation that was not produced overnight, but I suspect, even though I don't know for sure, that it was in anticipation of this great Supreme Court decision. And so, again, it just goes to show you how focused they are on Consumer Financial Protection Bureau, that they would get well prepared when this decision came down to say, oh, they got us on that one, but we're going to get them on something else. We got a lot of other ways, but we're going to go after this Consumer Financial Protection Bureau. And I'm surprised, really, that you're being so comprehensive in the way that you're responding so quickly to the decision by the Supreme Court. And so I'm so adamantly opposed to what Ms. Kim is doing. I would have expected something like this from Mr. Barr. not Ms.
Will the
Kim.
gentlelady yield?
I yield to Mr.
Well,
Barr.
I'm just so glad that the ranking member is in agreement, in full-throated agreement with Justice Clarence Thomas on something.
Well,
I yield back.
I don't know if Justice Thomas did something right for the first time. I've not, examined whether the vote was, total and comprehensive. But if he did, maybe he has started down the right direction, because I want to tell you, he has been going in the wrong direction ever since he was,
Remind members to
nominated
direct
and
their
granted
comments
the
to the
Supreme
chair.
Court decision. And so, let me just say this again, Ms. Kim, I don't know, how you got to this decision, who all helped you with it. Like I said, Mr. Barr is basically defending you, but he was the one that I would expect to have done this. So the next time anybody on your side of the aisle helps you to do something like this, remember that give it to Mr. Barr. This is not your kind of legislation.
Again, let's make sure that we are directing our comments to the chair. Does the gentlelady yield back?
I yield back.
Lovely. Is there any further debate on this amendment? If not, the question now occurs on the amendment offered by the gentlewoman from Texas, Ms. Garcia. All those in favor of the amendment shall signify by saying aye.
Aye.
Am I going out?
All those opposed should signify by saying nay. Nay. The
Nay,
nays
nay,
have it.
absolutely, nay, 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 yes.
Oh, really? You're opposed to the amendment?
I'm opposed to,
No.
I'm not opposed to amendment, I'm opposed to the bill.
In the
I support the
opinion-
amendment.
In
Yes.
the opinion of the chair, the nays have it.
Oh, my God.
The nays have it, and the amendment is not adopted.
Madam Chair, I ask for a recorded vote.
A recorded vote has been requested. All those in favor of recorded vote, raise your hand. A sufficient number having raised their hands, a recorded vote is ordered pursuant to subsection C5 of Rule 3 of the committee rules. Further proceedings on the amendment are postponed. Is
have
there
an amendment at the
any further amendments? Okay.
I have an amendment.
For what purpose does the gentlewoman from
I have
California?
an amendment at the desk.
Gentlelady is recognized.
My amendment.
Oh, I'm so sorry. We're going to pause and allow the distribution
All
of
right.
your amendment,
Okay.
Madam Ranking Member. Have all members received the amendment? The clerk will report the amendment.
Amendment to the amendment in the nature of a substitute to H.R. 8338 offered by Ms. Waters.
Without objection, the amendment is considered read. Now, the gentlewoman from California, the ranking member, is recognized on her amendment.
Thank you very much, Madam Chair. My amendment would require the Consumer Financial Protection Bureau to conduct a comprehensive study and certification within 6 months to ensure that the changes proposed in H.R. 8338 will not result in consumer harm or discrimination by financial institutions covered by this act. Considering the significant concerns raised by myself as well as consumer advocates and stakeholders regarding the negative impact of H.R. 8338, it is imperative that we take proactive steps to safeguard consumers and ensure that any changes to existing regulations do not result in harm or discrimination. This amendment underscores what should be all of our commitment to responsible governance and consumer protection by mandating a thorough study and certification process by the CFPB. We can ensure that the interests of consumers are prioritized. So I would urge my colleagues to support this amendment as a necessary safeguard against inevitable consumer harm and discrimination resulting from the enactment of H.R. 8338. Let us ensure that any legislative changes we make are in the best interest of the American people. I yield back.
Gentlelady yields back. Is there any further debate? Gentlelady from California, Ms. Kim, is recognized for 5 minutes.
I want to thank the gentlewoman for offering that amendment, but I want to let you know that we don't want to delay this legislation from moving forward by having regulatory agency to certify this through more studies after studies. Remember, there is already consumer protection, and Congress writes the laws. Congress does not ask the IRS to certify whether tax laws will harm consumers. So on that basis, I do not support this amendment, and I urge my colleagues to vote no.
All right, the gentlelady yields back. Is there any further debate on the amendment? If not, the question occurs on the amendment offered by the gentlewoman from California, the ranking member Waters. All those in favor of the amendment shall signify by saying aye.
Aye.
All those opposed shall signify by saying nay. In the opinion of the chair, the nays have it. The nays have it, and the amendment is not adopted. For what?
Recorded vote is requested.
Okay, a recorded vote has been requested. All those in favor of a recorded vote, raise your hand. A sufficient number having raised their hand, a recorded vote is ordered pursuant to subsection C5 of Rule 3 of the committee rules. Further proceedings on the amendment are postponed. Is there further amendment for discussion? Lovely, there being no further amendments. Without objection, the previous question is ordered, and recorded votes on the pending amendments have been postponed. Once those votes are taken, the committee will immediately consider the question to report the measure. Okay. Pursuant to notice, I call up H.R. 8339, the SEC Reform and Restructuring Act, introduced by myself, Mrs. Wagner, the chair of the Subcommittee on Capital Markets. The clerk will report the bill, which was distributed in advance.
H.R. 8339, to make improvements to the securities laws and for other purposes.
Without objection, the bill is considered read and open to amendment at any point. I recognize myself to speak on the amendment in the nature of a substitute, copies of which have been distributed in advance. Actually, the clerk will report the amendment.
Amendment in the nature of a substitute to H.R. 8339, offered
Without
by
objection, the amendment is considered read and will serve as base text for purpose of amendment. Turn your light.
I
Young ladies
object to
recognized.
treating the ANS as base text.
The ANS will be treated as a first-degree amendment.
I always forget where to put that, I'm sorry.
The gentlelady yields back. Okay, I now recognize myself for 5 minutes on H.R. 8339. As members of this committee, we have worked tirelessly to ensure our markets remain the deepest and most liquid in the world. Unfortunately, Chair Gensler's frenetic, partisan rulemaking and approach at the Securities and Exchange Commission, or SEC, threatens to undermine our markets and their standing as the envy of the world. Since taking office in 2021, Chair Gensler has overwhelmed the marketplace with roughly 60 new proposals and more than 30 final rules. In many cases, these rules include radical changes that stifle innovation, inhibit capital formation, and discourage economic growth, all without showing any clear data-driven need whatsoever. Chair Gensler has advanced these changes while abusing the rulemaking process, overstepping important legal and practical guardrails that foster thoughtful, carefully tailored regulations that benefit rather than harm our markets. Committee Republicans are not the only ones sounding the alarm. Chair Gensler has drawn criticism from investors, public and private companies, bipartisan members of Congress, and even his own SEC staff. Democrats and Republicans in both houses of Congress have opposed Chair Gensler's efforts to advance new rules without comment periods that approach the statutory minimum. And according to a statement by the SEC's Inspector General in 2022, even Chair Gensler's own staff and IG agree with these concerns. Still, Chair Gensler has rushed to finalize his agenda, forcing his staff to defend his most controversial rules in court. In the cases where Chair Gensler has the statutory authority to regulate, the quality of his rulemaking and cost-benefit analyses have suffered tremendously. Rather than performing a robust, detailed analysis of each new proposal, Chair Gensler's staff routinely fail to consider the overlapping and cumulative effects of their rules. Even the Department of Justice has commented that without considering these overlapping and cumulative effects, the SEC cannot measure the true impact of its rules on investors, on companies, or the markets. It is clear the SEC is in desperate need of reforms to bring accountability and transparency into the agency and its rulemaking process. H.R. 8339 would accomplish exactly that. This package of 7 bills recognizes the importance of stakeholder feedback, requiring the SEC to leave comment periods open for at least 60 days. This package also improves the quality of the SEC's cost-benefit analyses by, among other things, requiring the agency to consider the cumulative impact of its rules. The same rules would then be subject to regular review to determine if they carry out the SEC's three-part mission, and the analyses of certain major rules would be studied by the GAO. Finally, H.R. 8339 reminds the Commission that it remains accountable to Congress, requiring regular testimony before this committee. I urge all my colleagues to support this legislation that focuses on common sense reforms and ensures the SEC works better for everyone who wishes to enjoy the many benefits of our capital markets. I now yield back to myself the remainder of my time. Is there any further debate? The gentlelady from California, the ranking member, is recognized for 5 minutes to strike the last
word.
Gentlelady is recognized.
Thank you. Madam Chair, I'm afraid this bill will result in significant investor and market participation harm by decreasing the ability of the SEC to effectively police our capital markets. Let's take a closer look at some of the most harmful provisions in the bill. To start, the first title, which adds Administrative Procedure Act type requirements to the issuance of informal staff guidance, which will slow down the ability of the SEC to provide timely input on how registrants can better comply with Commission rules and statutes. This staff-level guidance is often provided at the request of public companies and is particularly helpful to smaller companies that have fewer resources dedicated to compliance. Further, the first title of this bill would give the SEC's chief economist the power to effectively determine whether staff-level guidance should be promulgated. I'm not aware of any other situation where an employee of an agency has that kind of power, and I think it is highly inappropriate. Next titles 4 and 6 would require the SEC and the GAO to waste precious time re-reviewing already finalized rules, which the Commission and the SEC staff already spend a significant amount of resources developing, often over the course of several years. Again, I'm not aware of any other agency that is subject to a similar requirement. The regulatory uncertainty that will come from this constant re-examination of SEC rules will be immense, making it more difficult for public companies to stay in compliance. Title 5 of the bill is particularly harmful as it would dissolve the Public Company Accounting Oversight Board, or the PCAOB, in its entirety and house it within the SEC itself. This will lead to politicization of what should be non-controversial accounting standards and will make it easier for companies to cook their books and hurt investors. As if it couldn't get any worse, this title actually repeals the section of law containing the Holding Foreign Companies Accountable Act, which was led by Representative Sherman and Anthony Gonzalez in the House and Senators Kennedy and Van Hollen in the Senate, in effect nullifying a major bipartisan act that requires China-based companies to submit to PCAOB auditing standards or be listed on U.S. exchanges. The Republicans did not want to dissolve the PCAOB 3 years ago when it was led by an unqualified Republican. Now that it is being led by a highly qualified Democrat who happens to be the first black woman to lead the agency, they want to dissolve it. Mr. Chair, we see this bill for what it is, a grab bag of anti-SEC provisions that will only hurt the Commission's ability to protect investors and help public companies comply with the law. I strongly recommend my colleagues a no vote on this package.
Gentlelady from California yields back. For what purpose does the gentleman from Ohio seek recognition?
I move to strike the last word.
Gentleman, Mr. Davidson is recognized for 5 minutes.
I think the chairwoman of the Capital Markets Subcommittee and the members who've worked to provide this bill today, it is clear that the Securities and Exchange Commission, we really have two problems. One is the current chair, Gary Gensler, has been uniquely bad as chairman of the SEC, so a role that he seemed to be well qualified for, but when he has gone there, you've seen he's abused the structure of the SEC, and they've had unprecedented failures. If you look at their actions in the debt box case alone, you would say something is amiss in the enforcement division. And it's clear they're not providing accountability that would reform it. In fact, they're doubling down, trying to make the agency even worse and less accountable. They've failed to provide clarity in so many ways for so many aspects of our market. And for these reasons, frankly, I had hoped that the Capital Markets Subcommittee would go a bit further in the legislative work. I had hoped that at this point we would have at least noticed for one of our hearings the SEC Stabilization Act, because it is spinning out of control, and it would alter the structure. It would eliminate the chairmanship that Gary Gensler currently holds, and it would create 6 commission members, so you would have parity. Because a lot of the abuses that we see that we're trying to remedy with this bill come from the fact that you've got a strong chairman that is pushing the Securities and Exchange Commission to do things that stretch the bounds of the law and, frankly, moves well outside it in the case of Gary Gensler's actions. So this does do some important things to rein it in, so I'm enthusiastic about it. I think we could do far more. And when it comes to the review of GAO, I think this is a good step in the right direction. I had hoped we would get REINS Act kind of limitations on their ability to do rulemaking, where they would come back to our authorizing committee and get authorization to do things that are broader than they are. So while we haven't been able to do that in a whole of government way, I hope we can begin to do it in a committee of jurisdiction way, and this SEC bill would provide such a good opportunity. Nevertheless, I'm not seeking to amend it because I do feel it moves forward some important ideas, and we'll see. Hopefully we'll find a swift path to the floor, and we'll see what the rest of our colleagues do, but I encourage everyone to move it forward. And Chairwoman, I thank you for your work, and I yield the balance of my time to you.
Gentleman yields back. Is there any more debate? For what purpose does the gentleman from California seek recognition?
I rise to strike the next to last word.
The gentleman is recognized for 5 minutes, Mr. Chairman.
There are a few companies that approach the SEC saying, we want to challenge, we want to litigate, we want to press things to the edge, and if we don't get the answer we want, we'll hire a lobbyist to talk to Congress. And those are big companies, and they're wonderful companies, and they would like to create a circumstance where everything the SEC is subject to the Administrative Procedure Act, and every time the SEC is required to adhere to that act, they are somehow found to not be in compliance. But there's a huge number of companies out there who aren't trying to push things past the edge. They just want to know what the law is, and they just want to get their registration done. And these companies don't hire lobbyists. They tend not to hire litigators. They just want an efficient system. And I think it is that second group that we have to focus on. I've enjoyed working with the gentlewoman from Missouri on capital markets issues over many years, and this package of bills contains some very good bills and very good ideas. But I do have to oppose it for at least two specific reasons. The first was discussed by the ranking member of the full committee when she discussed how this bill could affect the PCAOB and our success in getting the Holding Foreign Companies Accountable Act so as to force Chinese companies to not only provide audited financial statements if they're seeking American investors, but to make sure that the audits are subject to the audit of the PCAOB. We have learned since WorldCom and Enron that it is not enough to have a system of independent audits. You need, where public companies are involved, to have a system of auditing the audit. The second area where I have concern is in the very definition of regulations, and I don't want to nitpick, and this is a long 30-page bill with good things in it, but the definition of regulation is such, and I understand this bill is trying to force the SEC to follow the very burdensome Administrative Procedure Act whenever it issues a regulation. But the definition of regulation found on page 9 in subdivision 5 is quite troubling. It says that it means any statement of general applicability which would describe the procedure or practice requirements of the agency. We have testimony coming before us in this committee. I would hate to have Gensler say, well, I can't answer that question because that's a description of the practice and procedures of our agency, which cannot be described except pursuant to the Administrative Procedure Act. I don't want a circumstance where everything the chief accountant does to provide advice has to go through the Administrative Procedure Act. I certainly don't want a circumstance where every no action letter is regarded as a regulation. I don't want a situation where every speech given by the SEC commissioners, particularly the chair, has to go through that system. And so I recognize there are litigators out there who want to win their particular case by showing that this or that action by the SEC was covered by the Administrative Procedure Act, and they are allowed and they want what they want. But for us to go to a circumstance where the SEC is hogtied and can't turn around and can't testify, can't answer a question to Congress or a company without going through the Administrative Procedure Act, that would bother me a lot. So I look forward to the SEC continuing to comply with the Administrative Procedure Act, but not to define regulation in such a way that is broader than it is for every other agency in government, and so broad that we really couldn't ask the SEC to act. We want the SEC to be user-friendly when it can be, and I just think that this particular section would prevent that, and I yield back.
Gentleman from California, the ranking member of the Subcommittee on Capital Markets, yields back. For what purpose does the gentlelady from California seek recognition?
I move to strike the last word.
Gentlelady Ms. Kim is recognized for 5 minutes.
Thank you for yielding. First, I want to thank Capital Markets Subcommittee Chairwoman Wagner for your leadership on H.R. 8339, the SEC Reform and Restructuring Act, and for including my bill. H.R. 7030, the Reg Act, directs the SEC to review final rules every 5 years to determine if they are necessary or appropriate to carry out the SEC's three-part mission. If the SEC determines the rule is no longer appropriate, the SEC could revise or completely eliminate it. Additionally, under the Reg Act, the SEC would be compelled to consider the cumulative costs of each proposed rule, which is something that Chair Gensler has failed to address. Since the spring of 2021, the SEC has proposed and finalized over 60 rules. When we compare the pace and the scope of rulemaking with recent SEC chairs, only former SEC Chair Shapiro has issued more rules than Chair Gensler. The axis of rulemakings coming out of the SEC runs the risk of seriously damaging our capital markets. So we must protect the crown jewel of our economy, our capital markets, from harmful regulations. I urge my colleagues to support H.R. 8339, and with that, I yield the balance of my time.
Gentlelady from California yields back. Is there any further debate? Any amendments?
Madam Chair, I have an amendment at the desk.
The gentlelady from Texas, Ms. Garcia, has an amendment. We will pause while the amendment is distributed. Has everyone received a copy of the amendment? The clerk will report the amendment.
Amendment to the amendment in the nature of a substitute to H.R. 8339, offered by
Without
Ms.
objection,
Garcia.
the amendment is considered read. And the gentlewoman from Texas, Ms. Garcia, is recognized for her amendment.
Thank you, Madam Chair, and like the amendment before this one with Ms. Kim's bill, my amendment does not change any of the substance of your bill. It simply adds a rule of construction at page 2 before line 1. And the rule would suggest that there would be nothing in the act to limit the authority of the Securities Exchange Commission to restrict the ability of a registrant to provide access to women seeking medical services related to abortion. Madam Chair, as I noted earlier, women's rights are being curtailed, dismantled, attacked all over this country. So I must bring it up one more time to ensure that women as consumers have their rights protected. My amendment would ensure that the SEC can offer timely and necessary guidance to registrants that provide abortion access or in vitro fertilization services. Thanks to my colleagues on the other side of the aisle, companies that provide abortion services and access to in vitro fertilization services operate in a highly sensitive and often politically charged environment. The legal and regulatory landscape surrounding these services can change, rapidly influenced by state laws, federal laws, public policy, public opinion, media reports, and yes, even local ordinances. That is why the SEC must retain the ability to issue timely guidance to these companies or their investors to help them navigate these complex policies, ensuring that they remain compliant with securities laws while also managing risks associated with the provisions of these services. In recent years, several U.S. states have passed legislation with significant implications for health care providers that offer services like abortion and in vitro fertilization. For example, in Texas, Senate Bill 8, known as the Heartbeat Bill, effectively banned most abortions once a fetal heartbeat can be detected around 6 weeks in pregnancy. This law introduced complex legal risks for healthcare providers that could affect their operations and financial reports. Timely SEC guidance for companies in these situations would be crucial for compliance with securities laws and for informing investors about new operational and legal risks. It would also be beneficial for investors or funds that have exposure to these companies. Companies involved in providing healthcare services often face litigation that can impact their financial health and operation capabilities. These companies providing in vitro fertilization services may also be impacted by changes in healthcare laws and public policies, which can vary widely from one administration to another between states. SEC guidance that promptly addresses how these companies should approach such changes and their disclosures to investors would help maintain market stability. The SEC must be able to respond quickly to these changes with appropriate guidance that can help registrants adjust their operations and disclose in real time. Subjecting such guidance to APA-like processes would delay the dissemination of crucial information, potentially leaving companies and investors unprepared for legal shifts. Investors in companies that offer these medical services benefit from clear and current SEC guidance. This transparency helps them make informed decisions based on the potential risks and regulatory challenges these companies might face. Madam Chair, the amendment reinforces the idea that regulatory bodies should have the autonomy to execute their mandates effectively, especially when public health and welfare is at stake. By preventing unnecessary constraints from being imposed on the SEC, the amendment supports effective governance and ensures that regulatory responses are timely and pertinent. My amendment is needed to ensure that the SEC retains the necessary flexibility to support registrants in the rapidly evolving sectors of abortion access and in vitro services. This support not only protects investors, but also helps companies that offer these reproductive services to continue offering their services without undue regulatory risk. This, again, is evolving, it is urgent, and I urge all my members to support this amendment. I yield back.
The gentlelady from Texas yields back. I now recognize myself to speak on the amendment. I thank the gentlewoman for her amendment. There is nothing in this bill that necessitates this rule of construction contained in the gentlewoman's amendment. We are happy to work with the gentlewoman moving forward to address any concerns that she may have, but I do not support this amendment, and I yield back. Is there any further debate? The gentlelady from California, the ranking member, is
I
recognized.
move to strike the last word.
Gentlelady is recognized.
I support this amendment from my good friend Ms. Garcia of Texas, which would ensure that the SEC can continue to give clarifying guidance to public companies that provide abortion access or in vitro fertilization, also known as IVF. Madam Chair, I've been concerned, at the war on women that have been waged by, too many from the opposite side of the aisle. In the past few years, after Roe v. Wade was overturned, we've seen the swift enactment of state laws that limit a woman's right to obtain reproductive health care. There are times when there are those on the other side of the aisle have gone so far as to attack women's access to IVF. Thousands of men and women have been able to experience the joy of parenthood because of IVF. It is simply mind-boggling that we hear from those who claim to be about freedom and small government, but yet rationalizes their fight to insert the government into the most intimate personal choices that a woman can make. This amendment would protect companies like Hologic, EvoFem, and Day Ray that support women's health, women's right to choose, and women's right to access IVF by ensuring that they would continue to receive guidance from the SEC on how best to comply with relevant laws and regulations. I thank Ms. Garcia for this important amendment and for her leadership on women's issues. I yield back.
Gentlelady yields back. Is there any further debate? If not, the question now occurs on the amendment offered by the gentlewoman from Texas, Ms. Garcia. All those in favor of the amendment shall signify by saying aye.
Aye.
All those opposed shall signify by saying nay. Nay. In the opinion of the chair, the nays have it. The nays have it. The amendment is not adopted.
I ask for a recorded vote, Madam Chair.
A recorded vote is requested. All those in favor of a recorded vote, please raise your hand. A sufficient number having raised their hands, a recorded vote is ordered, and pursuant to subsection C5 of Rule 3 of the committee rules, further proceedings on the amendment are postponed. Are there any further amendments? For what purpose does the gentlewoman from Michigan, Ms. Tlaib, seek recognition?
Madam Chair, I have an amendment at the desk.
We will pause while the amendment is distributed.
Thank you.
Have all members received the amendment? If without objection, the clerk will report the amendment then.
Amendment to the amendment in the nature of a substitute to H.R. 8339 offered by Ms. Tlaib of Michigan.
Without objection, the amendment is considered read. And the gentlewoman from Michigan is now recognized on her amendment.
Thank you, Madam Chair. Title I of this bill would restrict or severely curtail the SEC's ability to issue investor bulletins, which is very critical. It would be an incredible disservice to the investing public and a serious setback to the principles of transparency and accountability in the financial markets to exclude investor bulletins. These communications allow the SEC to carry out its mandate by protecting investors and ensuring integrity of the financial system, again, through transparency. Investor bulletins play an important role, Madam Chair, in educating the public. It also helps demystify the financial markets and making them accessible to ordinary investors, our residents, our retirees. In an era marked by rapid, often harmful financial innovation and new investment products, these investor bulletins are often the first line of defense against potential abuses and misunderstandings that can lead to significant financial losses. So curtailing the SEC's ability to publish these investor bulletins would effectively silence a vital, unbiased source of information, leaving investors at the mercy of potentially biased financial advisors or worse, predatory actors. Timely publication of the investor bulletins can act as a powerful deterrent against financial misconduct. By clarifying the rules and the SEC's expectations, these communications, Madam Chair, can prevent the exploitation of regulatory like different things that are not clear, and discourage attempts to engage in practices that can harm investors. So again, Madam Chair, these publications also support the SEC's enforcement function. So by setting clear expectation through guidance in bulletins, the SEC not only helps prevent misconduct, but also strengthens its hand when it takes enforcement actions against wrongdoers. So reducing the agency's ability to issue these communications really, I think, will embolden and enable bad actors who might perceive this as a signal that regulatory environment is loosening. Finally, Madam Chair, limiting, again, SEC's ability to communicate openly with the public runs counter to the principles of democratic accountability and transparency. Investors have the right to understand the workings of the market in which they participate in the regulations that protect them. We know that SEC's publications in the past served this democratic function by ensuring that the public remains informed and engaged in the regulatory process. Again, given the importance of investor bulletins, Madam Chair, my amendment is pretty simple. It would exempt the communications from the definition of regulation under H.R. 8339 before us to allow the SEC to continue issuing these investor bulletins as it determines necessary. And so I urge my colleagues to support this sensible and targeted amendment, and I yield back.
Gentlelady from Michigan yields back. I now recognize myself on the gentlelady's amendment. I appreciate the gentlewoman's amendment, but it is entirely unnecessary and duplicative. The definition of regulation included in the text of this bill only applies to agency actions that it intends to have the force and effect of law. Given that investor bulletins would not have the force and effect of law, they would already be excluded. This amendment is unnecessary, and I would urge my colleagues to oppose it, and I yield back. Is there any further debate? I recognize the gentlelady from California, the ranking member.
I move to strike the last word.
Gentlelady is recognized.
I support this amendment from Ms. Tlaib, which would prevent investor bulletins from being subject to the onerous requirements of Title I of H.R. 8339. Investor bulletins serve a crucial role in educating the public, particularly retail investors, about different aspects of our securities laws and regulations. These rules are often very complicated, and staff-drafted investor bulletins help to break key concepts down and make them easier to understand, and therefore easier to comply with. H.R. 8339 would make it harder for SEC staff to put forth clarifying guidance in general by subjecting it to APA-type notice and comment requirements, even though these are not formal rules. While I vehemently disagree with this tactic, the least we can do is exempt investor bulletins from that requirement, which is exactly what Ms. Tlaib's amendment does. I support her common sense amendment and strongly urge my fellow members to do the same, and I yield back.
Gentlelady from California yields back. Is there any further debate? If not, the question occurs on the amendment offered by the gentlewoman from Michigan, Ms. Tlaib. All those in favor of the amendment shall signify by saying aye.
Aye.
All those opposed shall signify by saying nay. Nay. In the opinion of the chair, the nays have it. The nays have it, and the amendment is not adopted.
Can I request a recorded vote?
A recorded vote has been requested, and all those in favor of a recorded vote, please raise your hand. A sufficient number having raised their hand, a recorded vote is ordered. Pursuant to Section C5 of Rule 3 of the committee rules, further proceedings on the amendment are postponed. Is there any further amendment or discussion? For what purpose does the gentlewoman from Ohio, Ms. Beatty, seek recognition?
Madam Chair, I have an amendment at the desk.
We will pause while the amendment is distributed. Has everyone received the amendment? So the clerk will report the amendment.
Amendment to the amendment in the nature of a substitute to H.R. 8339, offered by Mrs. Beatty of Ohio. Page 2.
Without objection, the amendment is considered read. And the gentlewoman from Ohio, Ms. Beatty, is recognized on her amendment.
Thank you, Madam Chair. H.R. 8339 says, in effect, that whenever the SEC is to issue a commission statement, guidance, or any staff-level statements that have general applicability, these so-called regulations must abide by a process that's similar to the Administrative Procedure Act referred to as APA. While APA process is appropriate for formal rules, it has not been applied to SEC commission statements or SEC staff-level guidance. Subjecting staff guidance or SEC commission statements to an APA-like rulemaking process could be detrimental to the United States investors, particularly those who have exposure to China-based companies. The agencies charged by Congress to protect investors and the integrity of our markets must have flexibility to issue timely guidance, especially amidst the rapidly evolving international markets. Developments in the financial markets come at a fast pace, and we have seen particular risks related to China, where regulatory changes and economic policies can shift quickly and unpredictably. When developments occur that could impact the financial health of China-based companies, such as sudden changes in trade policies, regulatory crackdowns, or shifts in political climate, investors need immediate insights and guidance. The APA-like rulemaking process, which requires notices, comment periods, and potentially lengthy deliberations, could significantly slow the SEC's ability to react to new developments. The resulting guidance may be outdated by the time it is finally issued, reducing its utility and potentiality, leading to significant financial losses. In addition, the SEC's ability to issue quick commission statements or staff-level guidance would help financial stability. In situations where developments in China could have a ripple effect on global markets, immediate issuance of guidance or statements help maintain stability and confidence, avoiding uncertainty and financial disruptions. The bottom line, Madam Chairman, is that while the principles of transparency and public participation embodied in the APA are important, they must be balanced against the need for agility and responsiveness in regulation. This flexibility helps safeguard U.S. investments and maintains the integrity and stability of financial markets, which I know we support on both sides of the aisle. So my amendment would retain SEC's ability to offer commission statements. That's it. Let me read that again. My amendment would retain SEC's ability to offer commission statements or staff guidance as it relates to China, Russia, Iran. I urge my colleagues to support this amendment, and I yield back.
Gentlelady from Ohio, Ms. Beatty, yields back. I now recognize myself on the gentlewoman, Ms. Beatty's amendment. And I want to thank the gentlewoman for her amendment. She's a good friend of mine, Ms. Beatty. But there is nothing in this bill that necessitates this rule of construction contained in the gentlewoman's amendment. We are very happy to work with the gentlewoman moving forward to address any concerns she may have, but I do not support this amendment, and I yield back the balance of my time. Is there any further debate? The chair recognizes the ranking member.
I move to strike the last word.
The gentlelady from California is recognized.
I rise in support of Ms. Beatty's amendment, which says that the SEC shall not be hindered in providing guidance, particularly staff-level guidance that is intended to counter threats from China, Russia, and Iran. Madam Chair, SEC staff guidance plays a crucial role in helping investors and market participants to understand how to better comply with the law. I want you to know that our adversaries overseas can pose a serious threat to our national security and capital markets, and agency staff should not be hamstrung in their efforts to help U.S. investors understand these risks. H.R. 8339 applies burdensome notice and comment requirements to staff-level guidance, but Ms. Beatty's amendment ensures that staff guidance as it relates to the dangers related to our national security and competitiveness is able to quickly and efficiently be distributed. I strongly support this amendment and urge a yes vote. I yield back the balance of my time.
The lady from California yields back. Is there any further debate? If not, the question occurs on the amendment offered by the gentlewoman from Ohio, Ms. Beatty. All those in favor of the amendment shall signify by saying aye.
Aye.
All those opposed shall signify by saying nay. Nay. In the opinion of the chair, the nays have it. The nays have it, and the amendment is not adopted. Is there any further debate? There being no further amendments, without objection, the previous question is ordered, and recorded votes on the pending amendments have been postponed. Once those votes are taken, the committee will immediately consider the question to report the measure. Pursuant to notice, I call up H.R. 4551, the Protecting Investors' Personally Identifiable Information Act, introduced by the gentleman from Georgia, Mr. Loudermilk. The clerk will report the bill, which was distributed in advance.
H.R. 4551, to prohibit the Securities and Exchange Commission from requiring that...
Without objection, the bill is considered read and open to amendment at any point. The gentleman from Georgia has an amendment in the nature of a substitute, and copies of which have been distributed in advance. The clerk will report the amendment.
Amendment in the nature of a substitute to H.R. 4551, offered by Mr. Loudermilk of Georgia.
Without objection, the amendment is considered read and will serve as base text for purposes of amendment. The gentleman from Georgia is recognized for 5 minutes.
Thank you, Madam Chairman. Following the 2010 flash crash, the SEC promulgated Rule 613 to establish the Consolidated Audit Trail. The CAS system is intended to collect U.S. securities market data, allowing regulators, self-regulatory organizations, and various contractors to track a securities transaction throughout its life cycle. By compelling industry members to collect and report data, it accumulates a staggering 500 billion records every day, all of which will be accessible to thousands of employees at the SEC and SROs with little to no accountability for how it's used. To make matters worse, each record is linked or linkable to the identity of an individual investor. The CAT program is not funded through regular appropriations and is administered by industry members who are not directly accountable to Congress. The CAT's implications for U.S. national security are also concerning. Congress has little insight into how this data is protected from hostile foreign actors or cyber threats. As a database of unparalleled scope and scale covering the deepest and most robust capital markets in the world, the CAT is a prime target for foreign intelligence and cyber criminals. In 2017, then SEC Chairman Jay Clayton warned, and I quote, "We will face the risk of unauthorized access to the CAT's central repository and other efforts to obtain sensitive CAT data. Through such access, intruders could potentially obtain, expose, and profit from the trading activity and personally identifiable information of investors." Congress should take steps to reduce the potential threat posed by the CAT's data collection by preventing its collection of highly sensitive, personally identifiable information. The SEC might argue that CAT's usefulness outweighs the tremendous national security risk posed by such an exhaustive database. Unquestionably, a record of every American's market activity would be useful to regulators, such as having a record of every American's book purchase, grocery receipts, political donations, or tithe would be. To quote Justice Lewis F. Powell's concurring opinion in California Bankers Association versus Schultz in 1974, he said, "Financial transactions can reveal much about a person's activities, associations, and beliefs." In the case of the consolidated audit trail, a person's investment activity can paint a clear picture of their values. We vote for what we believe in with every transaction. In his opinion, Powell goes on to conclude that at some point, governmental intrusion into our financial lives implicates legitimate expectations of privacy. Through my legislation, Congress can and should strike a clear line and protect the privacy of millions of American investors that rely on our capital markets. Finally, I want to be clear. Retail investors do not have access to consolidated audit trail data. It is not a tool of public transparency. Instead, it is a surveillance tool that requires retail investors to report their most sensitive personal financial data to the SEC, FINRA, and an army of unaccountable staff and bureaucrats, as well as the cyber criminals and malign foreign actors who will target the database. In return for surrendering all of their data, retail investors will get little more transparency than they already have. While it's worthwhile to discuss ways to improve transparency in the markets, my bill is intended to protect individual investors from the needless collection of their personally identifiable information and preserve the security of our capital markets. My bill would not eliminate the CAT. The SEC would still be able to track and analyze market activity, but neither regulators nor unauthorized users will be able to force a firm to divulge an American investor's personally identifiable information without cause. I urge my colleagues to stand for investors' data privacy, national security, and vote yes on H.R. 4551. Thank you, Madam Chair, and I yield back.
Gentleman from Georgia yields back. Is there any further debate? For what purpose does the gentlelady from California seek recognition?
I move to strike the last word.
The ranking member is recognized for 5 minutes.
Madam Chair, this bill severely curtails the ability of the SEC to monitor our markets for volatility and illicit activity that harms investors and ultimately makes it more likely that investors will lose money in the future. It does so by gutting the Consolidated Audit Trail, or CAT, which was put in place to expand the data available for regulators to surveil the market for volatility and illegal activities like insider trading, wash sales, and manipulation. The CAT came about after the 2010 flash crash in which markets plunged and investors lost nearly $1 trillion in market value, due in part to aggressive high-frequency trading algorithms and individual bad actors manipulating the markets. To help better prevent such volatility and losses and to hold those who contributed to them accountable, the SEC created the CAT to efficiently track activity throughout our capital markets. The CAT allows the SEC to quickly access the data that they need to analyze disruptive market activity. The CAT's use of personally identifiable information, or PII, P11 helps the SEC more quickly to precisely ascertain wrongdoing in our markets and helps the agency to identify bad actors so that the agency can then levy civil and administrative actions against them. These penalties can be used to reimburse investors for their losses. This bill would prevent the CAT from using P11. The CAT is the primarily and sometimes the only mechanism for surveillance for the market, manipulation, and other trading activities. The CAT can identify and help regulators to stop that, but if this bill is passed, regulators would be unable to engage in even basic policing of the markets in ways that have been done for decades. By restricting the CAT's use of P11, oh, it's II, okay. It is II. By restricting the CAT's use of PII, this bill reduces the overall effectiveness of the CAT and therefore the agency's ability to protect investors from future harm and puts us at increased risk of another flash crash. Just like Republicans quickly forget the factors that led to bank failures last year and immediately started to push regulators to weaken Basel III capital standards, Republicans are again forgetting that history has taught us and pushing legislation that will doom us to repeat history. Furthermore, the concerns that led to the production of this bill about consumer privacy are completely baseless. The CAT already has safeguards in place to ensure PII is not improperly accessed. In fact, regulators don't currently have direct access to PII information. They only have access to mask identifier. The actual human PII is only available when it is necessary to facilitate an investigation. Additionally, I'd like to point out the hypocrisy of Republicans for caring about the SEC's access to PII through the CAT, but they say not a peep about broker-dealers who have direct access to PII as well. But of course, this bill does not address broker-dealer access to PII. It is focused on hamstringing the SEC's ability to protect investors while leaving intermediaries like broker-dealers exempt from its requirements despite their similar practices. Madam Chair, I strongly urge members to vote no on this bill, and I thank you, and I yield back.
The gentlelady from California, the ranking member, yields back. For what purpose does the gentleman from Arkansas seek recognition?
Strike the last word.
Gentleman is recognized. Mr. Hill for 5 minutes.
Appreciate Chair Wagner, and of course, I thank my friend from Georgia, Barry Loudermilk, for offering this important bill before us today, and I thank Chairman McHenry for making sure it's timely inclusion in this markup. I support the Protecting Investors' Personally Identifiable Information Act that will go forward to try to protect our individual families, their households, personal private information from being included in the SEC's proposed Consolidated Audit Trail, better known as CAT. The SEC has been working on CAT for over a decade now. It collects and stores personally identifiable information for every American that trades stocks or options from every account of every brokerage firm. Let's be clear, that's what it does. It's much broader than surveilling trades in a particular stock on a particular day. The exchanges have that capability, the individual broker compliance departments have that ability, and this goes way beyond that. This effort, has been said by Mr. Loudermilk and the ranking member, was originally supposed to be a response to the flash crash and high-frequency trading. But it's morphed, Mr. Loudermilk, from a small, delicate house cat into a potentially uncontrolled saber-toothed tiger. It will subject every retail investor to constant surveillance of their financial transactions without any suspicion of wrongdoing. In my judgment, the SEC and FINRA have today the market surveillance tools that they need to get the information required to assure orderly, transparent, fair, and fraud-free markets. They have the opportunity to do a sweep exam of all trades in a particular stock anytime they want to. They have the opportunity to pull a blue sheet and have that kind of data produced immediately. It's collected, but it's not collected in this form where it's so risk to privacy concerns. It really has the potential of being yet again another Big Brother style of surveillance collection item that we've been full of here. So I'm opposed to this effort and for Mr. Loudermilk's bill for three key reasons. One, privacy. We see this in the CFPB's Home Mortgage Disclosure Act that collects information on home buyers, or the recently FinCEN beneficial ownership database that's going to collect LLC information on millions of American small businesses. You know, Madam Chair, 60% of America's private information is already public out there in the public databases. I serve on the House Intelligence Committee. I work on the AI task force. The ranking member and I were just in an AI task force meeting this morning where we were told this information, that 60% of what we consider private information is already out there in big public accessible databases for bad actors to access. This compounds that. And sure, broker-dealers have personal information. They have a contract to represent you. They have a dealer agreement with you to be your investment advisor. So yes, they have your social security number, your name. They help you manage your investments. And they have strict liability and regulatory liability if they ever release that for any reason. And that's another problem with the CAT. Who pays for a breach? If the CAT is breached by some mistake made by the federal government, who gets stuck with the bill on that? I think families will, and I think our broker-dealers will. Secondly, national security. We don't need to create another big target for a cyber threat in this country. The CAT database is a prime location for cyber criminals to steal the identity of Americans, add to that public data that's already available, look for patterns of life, and target people for theft with information available on this database. Not to mention unconstitutional violations of the Fourth Amendment and phishing expeditions by people who have access to this data. Third reason I'm opposed to CAT and support Mr. Loudermilk is overall cost. The cost of implementing this has exploded, and that's why I'm concerned about it. I thank Mr. Loudermilk for his work. I have two things to add to the record, Madam Chair. First, an outstanding article about the risks of the CAT called "The Securities and Exchange Commission is Watching You" by former Attorney General Bill Barr, and a letter from our Attorney General in the state of Arkansas, Tim Griffin. Both are opposed to the CAT, concerned about privacy being violated, and urging acceptance and direction that Mr. Loudermilk take.
Without objection.
Yield back.
Gentleman from Arkansas yields back. Is there any further debate?
Madam Chair.
I recognize the gentleman from New York, Mr. Garbarino,
Move to
for
strike the
5
last-
minutes to strike the last word.
Last word, I yield to my colleague, Mr. Loudermilk.
I thank the gentleman from New York for yielding. Look, we're talking about the government collecting up to 500 billion records per day without the consent of the investors. This will be the largest data collection in the history of our country on everyone who happens to buy a stock or a partial stock. This is well beyond anything that we have ever conceived of collecting personal and private financial information on people in this country, if this is allowed to continue in the way that it is right now. The minority talks about protecting consumers. This is by far the largest violation of consumers' rights in the history of our country. And as my good friend from Arkansas said, it will become one of the top targets by foreign nationals. This bill does not stop the SEC from being able to look for bad actors. It simply protects the privacy of individuals. And I yield back.
Will the gentleman yield?
I will.
I appreciate it. I want to just say that the Consolidated Audit Trail, or CAT, originated from SEC Rule 613 and was designed to reduce market volatility following the 2010 flash crash. As proposed, the CAT would be the largest securities database ever created. Think about that for a moment. And the most massive government database of any kind outside of the National Security Agency, the NSA. According to former Attorney General Barr, who wrote that marvelous op-ed, he quotes, "Accepting this sweeping surveillance would eviscerate fundamental privacy protections." And I share the Attorney General Barr's concerns, and as members of this committee have repeatedly made clear, there is a constitutionally protected interest in the confidentiality of financial transactions and personal financial information. The CAT would violate these rights by granting SEC or SRO employees access to every investor's financial transactions without any evidence of wrongdoing. The solution to this problem is simple. H.R. 4551 prevents the SEC from requiring an exchange, a National Securities Association, or a member of such an exchange or association to provide personally identified information with respect to the individual or reportable event. I thank the gentleman from Georgia, Mr. Loudermilk, for his legislation. I urge all my colleagues to support this legislation, which ensures that everyday Americans investing in the stock market will have their privacy rights protected, and I yield back.
Well, Madam Chair, would the gentleman yield just for one moment?
Yes.
Let me just add to this that the SEC Chairman Gensler is not masking what their purpose is here. He sat in that chair right there and answered my question, that they will be actively perusing the database, looking at private individuals' investments, just looking for something that may be wrong. That is a violation of the Fifth Amendment of the Constitution. Collecting this data is a violation of the Fourth Amendment of the Constitution. And we've taken an oath to uphold the Constitution. So I strongly urge members on both sides of the aisle here, protect the American consumer and their privacy. And I yield back to the gentleman from New York.
Gentleman yields back to the gentleman from New York. Does the gentleman New York yield?
I yield.
The gentleman from New York yields. Is there any further debate? Yes, the gentlelady from California is recognized.
Thank you.
Oh, wait, I believe you already spoke.
Oh, I did.
Didn't you?
Yeah.
You did already speak. And
I did.
yes,
I did.
the gentlelady from California already spoke. Is there any further debate? There being no further discussion or amendment to the bill, the question now occurs on adoption of the amendment in the nature of a substitute offered by the gentleman from Georgia. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay.
Nay.
In the opinion of the chair, the ayes have it. The ayes have it. The amendment is adopted. Hang on. The question now occurs on ordering the bill, H.R. 4551, as amended, reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. Nay. In the opinion of the chair, the ayes have it. The clerk will report, or pardon me. For what purpose does the gentlewoman from California seek recognition? A recorded vote has been requested. All those in favor of a recorded vote, raise your hand. A sufficient number having raised their hand, a recorded vote is ordered, and pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Okay. We're going to pause for one moment, please.
Pursuant to notice, I call up H.J. Res. 100, a resolution providing for congressional disapproval under Chapter 8 of Title 5, United States Code of the rules submitted by the Securities and Exchange Commission relating to cybersecurity risk management strategy, governance, and incident disclosure, introduced by me. The clerk will report the resolution, which was distributed in advance.
H.J. Res. 100.
Without objection, the resolution is considered read. The gentleman, I recognize myself for 5 minutes. I urge all of my colleagues to join me in supporting HJ Res 100, a congressional review act that nullifies the Security and Exchange Commission's ill-advised cybersecurity disclosure rules. Under this new reporting regime, public companies are required to publicly disclose any cybersecurity incident they determine to be material within 4 business days of the company's determination. Further, the final rule requires new annual report disclosures regarding a company's cybersecurity policies, procedures, and risk management. Disclosing such information could potentially compromise the confidentiality of a company's cybersecurity program and reveal details such as the scope and frequency of testing, the nature of third-party systems, and specific remediation activities. Public and private stakeholders across the federal government, including the Biden administration, and critical infrastructure sectors have emphasized the need to harmonize existing and future cyber regulations. Unfortunately, the SEC's disclosure rules do just the opposite. Instead, they directly conflict with the ongoing efforts required under the Cyber Incident Reporting and Critical Infrastructure Act, CIRCIA. Through this legislation, Congress solidified its intent that CISA is the lead federal agency for cybersecurity and should be the primary intake point for cyber incident reports.